Yeah, good morning, everyone, to today's section, day 26th, which is on Monday, 3rd of May, 2021. And today we'll be discussing employee benefits. And we'll discuss this with respect to the requirement of IAS 19. And welcome to the section. And that will also lead us to further discussion on similar things that deal with employee benefit, and that is with respect to share-based payments. Okay, and we believe this will be a fruitful discussion as we proceed in this. And I believe some of us, if not all, will have come across some level of understanding or discussion with respect to the requirement of IFRS 2. And that's IAS 19 and IFRS 2 on employee benefits and share-based payments. Okay, today we pray we're able to wrap up on employee benefits, and if practicable, we can begin our journey towards IFRS 2. Otherwise, we'll have another section where we'll discuss extensively the requirement of IFRS 2. I've made available the material to be used with respect to IFRS 2 to you guys, and also I've provided some information regarding employee benefits to us, especially with respect to actuarial report. At this point in time, I want us to more or less commence the class. Let's put up our cameras as we commence the class. Okay, now when we talk about employee benefit, what are we talking about? We are talking about much more on all forms of benefits that accrues to employee during and after employment. Okay, which means all forms of benefits that accrues to employee during and after employment. And if you check, I would like us to give examples of such benefits. And I believe most of us, if not all, are employees or employers of labor. And in that vein, we should have better understanding of what are the kinds of benefits that accrue to employees. Now, let us give examples that is known to us. Examples of benefits that accrue to employees during and after employment. The floor is open. I want us to list them one by one as known to us. And that will lead us to the discussion we're having today.
Okay, good morning, everyone.
Good morning. Over to you.
Okay, I was looking at maybe salaries and wages, pension, and health insurance.
Let's pick it one by one. Salaries and wages. What again?
Pension.
Pensions.
And health insurance.
Let's say medicals.
Okay, medicals
and health insurance.
So those are the.
Let's say group life assurance.
Okay.
What other examples known to you?
We have leave allowance.
We can add bonus schemes and gratuity.
Okay. Leave allowances. Sick leave allowances. This first is annual leave. Bonuses and profit sharing. What again? Somebody said gratuity.
Gratuity scheme.
Gratuity. How does that differ from pension? We'll discuss that, if any. What again? What examples again? More examples?
So we can talk about paid maternity leave.
Okay. All those ones, let us say, falls under leaves and allowances, both sick and also of things.
We have
What again?
NHF.
Eh?
NHF, National Housing Fund Allowance.
No, that's not an allowance in Nigeria. That's a contribution from your own basic pay.
Okay.
Yeah. Okay, let's look at non-monetary benefits. Or what you can call benefits in kind. Example, housing, cars. What other example of non-free and subsidized goods? If you work in, what's it called? Fast-moving consumer goods, FMCGs. What again? If you work in financial institution, you can get below market interest rate loan. What again? You can get share options or grants, share grants. We're going to discuss that. What other thing can you have as benefit? What you can also get as benefit may include, even after employment, after retirement, once you have met certain criteria, post-employment medicals and life policy. You can equally, which is the final one that everybody tries to avoid, which is much more redundancy. Redundancy payments. Which arise from termination. Okay, these are examples, practical examples of employee benefits. Now, what we are trying to discuss here is to identify that all of these benefits we have so mentioned can be grouped as follows. In line with financial reporting, all of these benefits can be grouped into 4, namely short-term employee benefits, post-employment benefits, other long-term benefits, and termination benefits. Now, let me explain what they are one by one, or let me give you guys to discuss it one by one before I venture into what is expected to be in line with the requirement of IAS 19. But now, up to you guys, what is your perspective of short-term benefits? And from the example here, can you tell us what constitutes a short-term benefit? Let me try to abbreviate them. From these examples, can you give us a clue on which one constitutes short-term benefit and why? And which one constitutes post-employment benefit and why?
Okay, sir.
Okay, over to you.
Yeah, I want to believe the short-term benefits are those benefits that by their nature are paid or the employees enjoy within a period of time, maybe usually 1 to 3 years, and they are routine in nature. For example, I could say maybe wages and salaries, sick leave, leave benefits, group life assurance. They look like a short-term benefit to me.
What is the homogeneous factor that you can use to describe those ones you have mentioned?
So the factor I see that is common with them is the time or period in which they are settled. For example, wages and salaries is usually within a month. Group life is annually. Sick leave allowances are annual payments. Bonuses or profit sharing, they are annual payments. So that's why I want to classify them under short-term benefits.
Okay, which means, in summary, your description of short-term benefits constitutes benefits to employee other than termination benefits that you expect to settle only before 12 months after the end of the annual reporting period in which the employee had rendered such service. Is that correct?
Oh yeah, that's clearly what's on my mind here.
Okay, which means everything you paid immediate, which you have enjoyed the benefit of the service from the employee as an organization, and which you will pay immediately or not more than 12 months from your reporting date, will be considered as short-term benefits. Now, from this example here, can we identify short-term benefits? What are short-term benefits here? Salaries, and wages. Can we say pension is a short-term benefit from this definition? Which answers?
I think yes, based on the contributory scheme we currently have in the country.
Okay, that means, is it payable to the employee in 12 months from the year end?
In fact, critically, it is paid monthly, similar to.
Okay, I'll put question mark.
Yeah.
I'll put question mark. Probably we'll come back to it. Medical and health insurance when you are in employment.
Short-term.
I think it's short-term benefit. Group life is short-term benefit. Leave allowance, sick leaves, all of these are short-term benefit. Every form of allowances. Bonus and profit sharing. There's an element of it that is short-term benefits. And there's another element of it, which we'll get to, that is other long-term benefit. And I'll tell you the distinguishing factor. Let me asterisk it. Gratuity, is it short-term benefit? Gratuity is not short-term benefit.
Gratuity is other long-term.
I don't think it's also other long-term. We'll come back to that. Non-monetary benefits, such as housing, providing car, free and subsidized goods, giving loan at below market rate, all of these are short-term benefits. Share options and grants. We can't classify it as any of these four because it is scoped out of IAS 19. Rather, we apply IFRS 2. That is what will make us to discuss share-based payments, which means this is out of it. It is out of IAS 19. Post-employment medical and life policy, they are not short-term. Redundancy payments are not short-term. Therefore, from all what we have mentioned, these are the examples of short-term benefits as inscribed. The next question then is, what is a post-employment benefit? Who can assist us in that? Who can assist us in that?
Post-employment benefits are those benefits that are accrued to employee after their service with the employer.
Post-employment benefits. Can you repeat it again?
Okay, I said I refer to post-employment benefit are benefits that are settled or that accrue to employees after the period of their service or after their engagement with the employer.
Okay. Now, I think you are right. With respect to post-employment benefits, any employee benefits other than those that can be considered termination benefit or short-term benefit, but of which it is payable after the completion of your employment. That is, you only, no matter how these benefits accrue to you, no matter how entitled you are to it, you can only start to enjoy it only when you are no longer in service. Which means it's either you have resigned from that employment, it's either you have been retired from that employment, or by way of termination or otherwise, you are no longer in that employment. That benefit to which has accrued to you over time, listen to me carefully. Those benefits that has accrued to you over time as a result of your service to an entity which you start to enjoy only after you are no longer in employment is what qualifies as post-employment benefits. Now, from what we have here, can you give me an example of such?
Okay, I think hello, that will be pension. And
pension is post-employment benefits.
yes, pension
That
and
contributory
post-employment
or
medical.
otherwise. Gratuity is post-employment what? Benefits. Post-employment medical and life policy are post-employment what? Benefits. Does that make sense? Does that make sense?
Yes.
Okay. Now, who can now provide a clue to other long-term service benefits? Other long-term service benefits. Who can provide a clue? Who provide a clue?
Maybe that will be looking at only group life assurance.
Group life assurance, which we have considered as post-employment. How can we now consider it also as other long-term? Now, let me give you an example of other long-term. Other long-term is attributable to your long service awards. What are your long service awards? Some organization will say, if you have spent 20 years, you're entitled to a house, which is different from normal housing allowance or providing you house as a management staff. No, this one is a gift. They gift you a house, they gift you a car, which is different from a status car. This one is a gift that automatically becomes yours, whether you are still going to continue in service or not. They give you cash. When I say cash, it's not one basic month salary, and they give you something tangible in order to celebrate your 5 years, your 10 years, your 15 years, your 20 years. But again, in considering this other long-term benefit, we must consider materiality. If you work in an organization or you are an organization that gives bag of rice, that give 1 month basic salary, that give all of those things, these are not material to the operation of the company. Therefore, such would have been termed normal short term. But we are talking of materiality. Anything that is material that qualify as long service awards in terms of monetary or non-monetary qualify as other long-term benefit. An example of that here is this bonus and profit sharing. Bonus that is tied to you working for, or that is tied to your performance for more than 1 year. You know, executive bonuses nowadays, because of issue of appetite for risk, they will tell you if you are able to sustain profitability over 3 years, you get this bonus after the 3rd year, which means it's not a yearly bonus. Such is other long term. Or bonus that is payable for more than 12 months, payable more than after 12 months of any financial year will also not qualify as short term, but rather other long term. Which then means executive bonuses that is tied over a number of years, staff benefits for those that are in employment by way of service award for long-term service that is material in nature. All of these are what qualify as other long-term benefits. Okay, other long-term benefits. I think I omitted long-term here. Let me put it there. Therefore, other long-term benefits. Another portion of other long-term benefits might be monetary benefits. Monetary benefits, which is attributable to long-term service award. Okay, these are examples of other long-term benefits. If you have a practical experience of that, can you also give me another example of other long-term benefits known to you or within your organization, other than those that I've mentioned?
So where I used to work before, they used to pay something like disability benefits. I'm not sure.
Disability.
Yeah, disability.
What is the basis of that benefit?
Not
What
100%
is
sure.
it?
I just know that the guy he used to be on a wheelchair. So sorry, after like a year or 2 years, I know that they paid him disability allowance or so benefits.
Okay, if we understand the rationale behind it, we can be able to classify it appropriately. But I believe from what you have said, it might fall in between short term and other long term. But the material fact of it, the substance of it, is what will majorly determine whether it is short term or it is other long term. Okay, but since it is something payable in every 1 year or 2 years, as I've seen in your position, it may be more of a short-term benefit than other long-term. Okay, any other contribution? Any other contribution? Okay, if there's none, let's look at the last one, termination benefits. What are termination benefits? What are termination benefits? No, I've not heard your voice today. Enaro Asama, over to you. I think you are employee benefit specialist based on your function. What can you tell us about termination benefits?
Sorry, my background is somehow noisy. That's why I was moved for this one. But my understanding about termination benefits are those benefits that accrued to employee when he or she ceased to be in employment, whether by way of notification or by accident.
Over to you, Asama.
Okay, so following what Mr. Nuruddin said, so those benefits that accrue to employees by way of being terminated from employment, that's what I think can be referred to as termination benefits.
Okay. Now, let me give you this practical example to demonstrate whether you have the understanding of what you've said. Okay. Imagine, I'll give you some scenarios. Let me start with the basic one. If you as an employee, you have spent 10 years in an organization, and if you resign normally yourself to go to another company, they will pay you your, let me say, your gratuity. And your gratuity is 10 million for simplicity's sake. But as you are preparing to resign to another organization, something came up in your own current organization where you were told, not only you, employees were told that based on aftermath of COVID-19 and some other things, and economic situation in Nigeria, the management is looking towards restructuring and some other things. All those stories continues. And that instead of the management laying off people, they first of all given employee first option of voluntary resignation. And for those that voluntarily will resign, will be paid 120% of what the entitlement ordinarily supposed to be. And what is the entitlement? That gratuity. Which then means that if you go within this scheme of redundancy, you'll be entitled to 120% of 10 million instead of 100% of 10 million if you have resigned on your own before now. The question then is, what is your termination benefit as an employee? Or as an employer, what is your termination benefit cost as regards the employee that have decided to take that route? Over to you. Anybody can answer?
Okay, so I think since gratuity itself is a other long-term benefit, so in this scenario, the question is, what is the cost? What is the termination cost of terminating the employee in this scenario? The gratuity of 10 million is other long-term, while the additional 20% that accrues to the employee can then be categorized as the termination benefits. In the case of the employee, I want to say the termination benefit of the employee is also that 20% that increased as a result of redundancy, not despising the fact that the employee already resigned. Well, that's my thinking.
Okay, thank you for your thinking. Who else? Who else?
I would say that maybe any other benefits that is paid to employees besides the normal gratuity, and that would be the termination of benefits. Also,
in this case, I've given you a practical illustration. What is the termination benefit here?
or the termination benefit is 20% on top of the 20% on top of the 100%. Says,
And what is that?
That would be 200. I mean 2 million on top of the 10. Yes, 2 million. So the 10 million would be
And what is now the 10 million? If the 10 million is not termination benefit, other than the 2 million, what then is the 10 million?
The 2 million, since it is the normal, it is for employee that is whether you leave or so it's gratuity, which is categorized as a post-employment benefits. The 10 million will be the post-employment benefits, then the 2 million will be the termination benefits.
The 10 million will be what?
The 10 million will be the post-employee benefit because it's the gratuity.
Okay.
Which is the post, so the 2 million will now be the termination benefit. And I think that is why I look at it. And also, let me just add this one. There is something I read that this company, Amazon, pays employees some benefit for them to resign. For those who are not motivated, who are not really happy working, they may not know about it, but they pay them off. If you resign, you are paid some benefits for resigning, and it's I think such kind of payment to encourage redundancy scheme. Is that what you call it? Okay. So that could be categorized as a termination benefit as well, to encourage employers, to encourage employees to resign voluntarily. Any payment paid to employees to resign voluntarily, I think we categorize as termination benefit.
Okay. Thank you very much. Which means you all got it right. The 10 million is not termination benefit. That is post-employment benefits. Because even without that scheme, if you have resigned on your own to another employment or you retire, that is what you are entitled to. Okay, but it is the incremental amount on top of you not willingly taking the option, but being induced by the employer that constitute termination what? Benefits. Therefore, in the perspective of the standard, what is termination benefits? Termination benefit from the perspective of the standard, I'm trying to okay, your termination benefit from the angle of the standard are employee benefit provided in exchange for the termination of an employee's employment as a result of either an entity's decision to terminate an employee employment before the normal retirement date, or an employee decision to accept an offer of benefit in exchange for the termination of employment. The second is the case in the scenario I've pointed out. Now, let me say, for example, the second scenario, the company lay off 20% of its workforce. And on that premise, the company board has decided to pay, one, your entitlement as it has accrued to you for the length of service you have worked, and two, they will pay you severance package for the untimely disengagement. Now, I want you to consider, are the two considered as termination benefit, or is it one of them or none of them? And how will you treat those two transactions? Over to you guys. Over to you guys.
I think it's the severance package, severance benefit that will be treated as termination benefit. The severance benefit on top of the normal post-employment benefit. So that severance will form actually form the termination benefit.
Okay. You are right. The severance package is the incremental cost attributable to the disengagement of staff before its due time or induced in exchange for its termination. While the normal one that will be based on your normal year of service, even if you have not been disengaged, that you will be entitled to will fall under post-employment benefit. I'm so happy that our starting point has demonstrated our level of understanding of employee benefits. Now, what is the concern over employee benefit? The concern over employee benefit is because over time, not all employee benefit has been captured in the books of a company. And where they have been captured, sometimes they have not been captured in appropriate period in which they relate. And part of the fundamental principle of accounting is matching concept and accrual principle. Matching concept means that in order to ascertain what your net income is, be it profit or loss, in any given period, you must appropriately match the cost incurred in that period with the income earned in that period. Now, we'll find over time that other than short-term employee benefits, most of other benefits are not accounted for at the appropriate time. Most times, they are accounted for on a cash basis. And what does that mean? It means they are only accounted for when they are paid, not necessarily when the company has enjoyed such service or related service from its employees. And that is what gave birth to the introduction of IAS 19. And IAS 19 tends to address both the complex principle relating to employee benefit, which is majorly within the post-employment benefits, and some within other long-term benefits. While also it tends to address the aspect of termination benefit where people commingle what's supposed or seldom supposed to be post-employment benefit, and they commingle it with termination benefit. And we have used two scenarios to demystify why we need to separate them based on the condition and attribute of each class of benefits. Now, we can now go into accounting for each of these benefits. And we'll start from short-term employee benefits. How do you account for short-term employee benefits? How do you account for short-term employee benefits? Because these are employee benefits that span within an accounting period and which they are payable not more than 12 months after the reporting date. Therefore, we need to accrue for such employee costs, employee-related costs, as it is being incurred. Now, what does that mean? Example. Whether you have money to pay salary or not, salaries and wages are accounted for in the period they relate as thus. A, upon accrual, you debit the staff cost, as you might describe it, and you credit probably salaries payable account with the amount of salaries and what? Wages. Now, upon payment, you debit your salaries and wages payable account, and you credit your mode of payment, which in this case is usually through your what? Bank, with the amount what? Paid. And this simple accounting entry assumes that there is no what? Tax. Assume there's no what? Tax. But if, let me state it there. No payee or other what? Deductions. If there are payee and other deductions, where there is payee or other what? Deductions, what do? What you do is first, A, upon accrual, you still debit staff costs. But in your staff costs, you have individual heads of account. When I say individual head of account, you have basic pay, housing, transport, etc. And you credit the portion that is actually payable to the staff account, that is the net pay that goes as cash in the hands of the employee. And other ones will go to other deduction. The most common deduction is payee. You take it to payee payable of the relevant tax authority, which is the tax aspect. Now, probably the entire cost is 1 million naira. You take 900,000 to salary payable, and you take 100,000 to this. Now, upon payment, payment to staff, that is the net pay. You debit your salaries payable account, and you credit your bank, 900K. And payee remittance to, let us say, LRS now, which is the tax authority for Lagos State, assuming it's resident in Lagos. You debit payee payable account, and you credit the bank. What this signifies is that even when you have not paid, it will not stop you from recognizing your cost. But what you will have substituted for that is that you show a liability for it. And that is a position of the standard. Any question? Any question? Any question? You guys are not contributing. Any question?
Number one is straightforward. It's clear. So this is like something to meet every day in. So this portion is straightforward.
Okay. If that is the case, which means I can summarize this discussion as follows. Can somebody read this out? Can someone read this out?
The accounting for short-term employee benefits is simple. The principles are the same as for any expense that is accrued over a period. Accounting for short-term employee benefits is fairly straightforward because there are no actuarial assumptions to be made, and there is no requirement to discount future benefits because they are all by definition payable no later than 12 months after the end of the accounting period. Recognition and measurement. The rules for short-term benefits are essential. The rules for short-term benefits are essentially an application of basic accounting principles and practice. A, unpaid short-term employee benefits as at the end of an accounting period should be recognized as an accrued expense. Any short-term benefits paid in advance should be recognized as a prepayment to the extent that it will lead to, example, a reduction in future payments or a cash refund.
Okay,
B,
hold on there. Who can explain what this means? Let me allow somebody that has managed payroll for many years. Aki Folarin, payroll specialist. Are you there? Aki Folarin, are you there?
Yes, sir. Yes, I'm
Okay,
here, sir.
use your experience to tell us what this means. Any short-term benefit paid in advance should be recognized as a prepayment to the extent that it will lead to reduction in future payment or a cash refund. Can you give us practical examples of that?
Okay. Any short-term benefit paid in advance should be recognized as a prepayment to the extent that it will lead to, for example, a reduction in future payments or a cash refund. A practical example that comes to mind is the handling of cash advance or expense prepayments for employees. So this standard is simply saying if you have paid an employee, for example, if you have paid an allowance, maybe transportation allowance to an employee, an allowance that maybe should cover a quarter. So the standard is simply saying any payment in advance should be recognized as a prepayment. So while you at the period, okay, let me use a typical example of a quarterly payment. A quarterly payment of transportation expenses now, let's say, is 200,000. If you have made a prepayment for transportation at 200,000 for this a category of employee, the standard requires that while you want to book this particular cost, if you're doing it on a monthly basis, assume that you have made a prepayment, that is advance payment for this employee, so that by the time the quarter expires, the 200,000 will just be written down in the period of which the employees have enjoyed this money. I don't know if my example is clear, sir.
Okay, thank you very much. Who else before I take the mantle?
Okay, so what happened is that is basically That is the way staff take IOU, salary IOUs. Those are the issues that come up. People collect salaries in advance in organizations. So these kind of situations can arise. So when you are paying the next salary, you deduct it from their salary. So up to the amount that they collected. So if, for instance, somebody collects IOU, salary IOU, and the person is resigning, and it can be net, the amount can be netted off from his outstanding benefit, or if there is no outstanding benefit, he has to refund cash to the organization. I think that's what it means.
Okay, thank you very much. Now, both of you have said it in all. Today, many organizations in Nigeria do not pay this kind of allowances in advance. But if you have worked in a bank, I think the banks will continue to do it mostly, and some of the FMCG. For example, in the bank, they pay you housing allowance ahead because they felt that every January people need to pay rent. Therefore, instead of paying your housing allowance every month, they pay you 2021 housing allowance in January, and that will form prepaid expenses. Now, what that simply means is that when you have such a prepaid expenses, what you are going to do in that regard, let me show you here. There are two sides to the coin. A, if they are prepaid housing allowance, what the company would do is to debit prepaid housing allowance, and that is a form of assets. It's an asset account under prepayment, but it's a short-term prepayment because this housing allowance is just for 1 year, and they will credit mode of payment, which is bank. Now, let's say with 1.2 million for the whole year, given that it's 100,000 per year, per month. Now, B is this will be amortized each month of the year as housing allowance expense. And when they amortize it, it will be debited to staff cost as housing allowance expense, and there'll be a credit to prepaid housing allowance account, which is the asset account. With what? With 100,000 naira per month. How do you arrive at 100,000 per month? That is 1.2 million divided by 12 months. Does that explain that to us? Does that explain it to us?
Yes.
Okay, that's what they're saying there. Now you can continue, Marian. From recognition and measurement. Start again. From recognition and measurement.
Sorry, before I continue, I wanted to just ask, what about leave allowance that is paid in block? Is it treated like this also?
No, leave allowance. Okay, before then, finish it. We'll come to leave allowance because there's a question I'm putting to you on leave allowance. Just start with this first. Go back to recognition and measurement. I'll move forward.
Recognition and measurement. The rules for short-term benefits are essentially an application of basic accounting principles and practice. A, unpaid short-term employee benefits as at the end of an accounting period should be recognized as an accrued expense. Any short-term benefits paid in advance should be recognized as a prepayment to the extent that it will lead to, example, a reduction in future payments or a cash refund. B, the cost of short-term employee benefits should be recognized as an expense in the period when the economic benefit is given as employment cost, except insofar as employment costs may be included within the cost of an asset, example, PPE. Short-term paid absences. There may be short-term accumulated paid as absences. These are absences for which an employee is paid, and if the employee's entitlement has not been used up at the end of the period, they are carried forward to the next period. An example is paid holiday leave, where any unused holidays in 1 year are carried forward to the next year. The cost of the benefits of such absences should be charged as an expense as the employees render service that increases their entitlement to future compensated absences. There may be short-term non-accumulating paid absences. These are absences for which an employee is paid when they occur, but an entitlement to the absence does not accumulate. The employee can be absent and be paid, but only if and when the circumstances arise. Examples are maternity or paternity pay, in most cases sick pay, and paid absence for jury service. Measurements. The cost of accumulating paid absences should be measured as the additional amount that the entity expects to pay as a result of the unused entitlement that has accumulated at the end of the reporting period. Example, unused holiday leave. A company gives its employees an annual entitlement to paid holiday leave if there is any unused leave at, can you scroll down? A company gives its employees an annual entitlement to paid holiday leave. If there is any unused leave at the end of the year, employees are entitled to carry forward the unused leave for up to 12 months. At the end of 2009, the company's employees carried forward in total 50 days of unused holiday leave. Employees are paid $100 per day.
Okay, I'll give you guys 5 minutes to deliberate on this, and we'll now commonly agree what the solution is. Okay, I want Akin Folarin, who is a pure expert, to mastermind this discussion. 5 minutes, over to you.
Okay, good morning, everybody. So the example before us about holiday leave, okay, maybe I should quickly read it again. So that someone maybe, apologies, I'm on my mobile device, so but I want to quickly read it. Okay, so the example is a company gives, please, can you hear me, please?
Yes,
Hello?
we can hear you.
Oh, okay, thank you. A company gives its employees an annual entitlement to paid holiday leave. If there's any unused leave at the end of the year, employees are entitled to carry the unused leave forward for up to 12 months. Okay. At the end of 20X9, the company's employees carry forward in total of 50 days of unused holiday leave. Employees are paid 100 naira per day. So simply saying, I pay you for every day of your holiday leave, but I allow you to carry it forward. Now, we are talking about a cutoff time of 20X9. The total unused holiday days are 50. Okay. How will this unused, okay, so in total, we are talking about 5,000 US dollars. So unused holiday leave of 5,000 US dollars, how will it be recognized in the books in 20X9? Or will it be recognized in the following year of 2010? That is the question before us.
As the payroll specialist, we're waiting for your answer.
No.
You're not meant to give answer.
So-
You are to moderate. Don't
So-
mind Miriam.
So basically, at the end of 20x9, I think the company we need to recognize the unpaid unused holiday leave.
The days, yeah.
That 50 days, we'd have to organize we accrue for it because it will still be used for the next, it can still be used for the next 12 months. So I think it will be accrued for as
We accrued it in 20x9, right?
Yes, at the end of for 20 no for yes 20x9, yes 20x9 divided for it to accrue for that. That's $5,000. It will be accrued for because is staff benefit. So it's only when at the end of 20x10 or what have you, if it's still not used, then you can now reverse that accrual. That way I see it. But it will accrue for it. So basically, once it accrues for it, is an expense. So once it is used, then that accrual will be debited and the bank will be credited once the employee take advantage as a made of credited and so on. But I guess if it's not used after 12 months, I guess it has to be reversed based on the way it is crafted. That's where I see it.
Okay. Any other contribution?
No, I'm just saying, so in addition to what he just said, but the question says the company's employees carried forward in total 50 days of unused. So it means it was not used as a 20x9. It was carried forward to the next year.
Yes, 2010, yes.
It was not used correctly.
Yes.
It was not used. But we should be mindful of the fact that it accrued in year 20x9. So it should have been a cost in period 20x9. Because it was not used, the company policy allows us to carry it forward, but we should ideally accrue it for 20x9.
Yes.
Yeah.
It should be accrued for, yes. Because it relates to 20x9.
Mr. Nuruddin, please. Can we have your
What period should it be accrued for? Is it 20x9 or 20x8?
It is an annual leave in 20x9. So
okay,
it should be
where should it be accrued? Okay, let's see what the solution is. Moderator, can you tell the solution?
Okay.
Okay, you are required. Okay.
Okay, please. The requirement is take the accrued accounting period for the unused holiday carried forward. So solution now. The short-term accumulating paid absences should be recognized as a cost and related liability in the year when the entitlement arises, that is 20x9. The liability should be realized as the carried forward holiday is used up or after 12 months if the carried forward holiday is not used. Can I take that again? The liability should be released, as the carried forward holiday is used up or after 12 months if the carried forward holiday is not used. Thank you, sir.
Okay, which speaks to what your conclusion was. Now, let me give you another example with respect to sick leave. You also have 5 minutes to deliberate on this. And you can take your pen and bio to also look at it, or if you can describe it. Over to you guys. Marian, kindly read it and let's superintend on it.
So the question is, Plyman Co. has 100 employees. Each is entitled to 5 working days of paid sick leave for each year. An unused sick leave can be carried forward for 1 year. Sick leave is taken on a LIFO basis, that is first out of the current year's entitlement and then out of any balance brought forward. As at 31st December 2008, the average unused entitlement is 2 days per employee. Kleinman-Co expects, based on past experience, which is expected to continue, that 92 employees would take 5 days or less sick leave in 2009. The remaining 8 employees would take an average of 6.5 days each, required to state the required accounting for sick leave. This one needs jotting down.
This one I need to look at every word.
You need to jot down.
Now, first thing you need to take notice, who can interpret this statement here? Let me highlight it because it's critical for you. I think it's too much highlighted. It overlapped. I want somebody to interpret this.
Said sick leave is taken on LIFO basis.
That is last in, first out. What does that mean?
So it means out of you have to take from your current year first before you can take from the previous balance of sick leave that you have.
And your previous will last after a year.
After a year, yes.
Okay. Since you understand that, you have 5 minutes, guys, to discuss it and come up with a common ground solution before I attempt to. Over to you guys. Akin Folarin, supervise over this. You are muted. Akin Folarin, you are muted.
Okay, thank you, sir. So I'm trying to jot in the relevant details down. So as at December 20x8, the average unused entitlement is 2 days per employee. 2 days per employee. Remember, we have 100 employees. 2 days per employee. So what represents the unused days on the average is 2 days per employee. So that means we have a total of 200 unused days of leave in year 20x8. Okay. Kleinman-Co expects, based on past experience, which is expected to continue, that 92 employees will take 5 days or less sick leave in 20x9. So out of the unused days, the management expect that 92 of them, so let's say 92% of the employees will take 5 days or less in 20x9. It's becoming more complicated. The remaining 8 employees will take an average of 6.5. Okay. The remaining employees will take an average of 6.5 days. 6.5 days. So my understanding of this is that because of the policy of last in, first out, so we have been able to identify our unused days in 20x8. So of course, from the previous example, we know how to measure or account for that. But in the next year now, the management said the average, the expectation is that 92 employees will take 5 days or less. So that means there are still unused days, while only 8% of the employees will take more than the 5 days. So, Mr. Enaoro.
Yeah, I'm trying to take note of something. But basically, let me just add this. You've You try to do that. So basically, you said 92 employees will take 5 days.
Yes.
5 days. So that 5 days will be for the current. Mind you,
Yes.
we're going to have 100 employees, and each of them is entitled to 5 days.
5 days, yes.
So that means we have 500 days.
500 days.
That's what.
For 20X9.
Yes. For 20X9. Yes, for 20X9.
That's for
And
92
for that 500
employees now.
Yes. Meanwhile, we have 200 days unused from 20X8.
X8.
So basically, 92 employees, 5 days, 5 days from the 500 days. 5 days from 500 days, and also because this is LIFO, then or less. So basically, then the other one, they said the remaining employee will take an average of 6.5 days.
6.5.
8 staff will take 6.5 days. That one will have to be together. If we add it together, 92 times 5, we should be getting maybe 460. 460. 8 times 6.5. 8 times 6 is 48 plus 4. That is 52. That's 52. 8 times 6.5 should give us 52. I don't know. I'm just doing it from. I know that 8 times 6 is 48. 8 times 0.5 is 4. So 48. So we have 512 days. So out of these 512 days that will be taken in 20X9,
X9.
500 will be for 20X9. The
20X9.
remaining 12, pardon?
Yes.
Yeah. So 500 of 20X9 will be taken. So the remaining 12 will now be taken from 20X8. So out of the 200 days that is unused, is only 12 that will be used out of it.
Out of the 200.
200. So definitely we're going to have 188 days that will be released back to the organization. So that 188 days times, how much is it? How much is a day? They would have been accrued for. So that is how much is per day. Per day, we are looking at how much is it? Is it 5 naira? 5 naira per day. How much is it per day?
There's no stated price per day. They just said 100.
Okay. 180 days would be reversed, would be released back to the organization. That's
because we know we must have accrued it for 20X8. So
yes,
we then reverse the number of days back as unused.
Yes.
But the 12 from that 200 will be expense, will be accounted for in terms of
yes.
Cost, the debit and credit the relevance. Okay.
We'll debit the accrued expense, then we'll credit the bill of payment for that. So that's my take.
Mr. Nuruddin, are we in line?
Yeah, Mr. Enauro has in fact summarized the whole thing, and I have the same submission with him. Actually, based on my computation here, I did it the way he explained, that we are going to consider the current employee leave first, which I did 92 times 5, which fall within the current period. This is subtracted from 500, which is the total current employee leave for 20X19. Then when we consider the remaining 8, which are to take 6.5 days each, we could observe that for 20X9, there is excess of 500 by 12 days. And that 12 days, since we are to apply LIFO basis for the leave, it means that the excess of 12 will be taken from the previous leave of 200 that we have
Unused leave, yes, sir.
unused leave as far as 20X8, which remains 188, and that is what I believe we are going to approve in our accounting in our accounts. Thank you.
Okay, can you look at the suggested solution? Thank you for lying. See whether it aligns with what you guys have discussed.
Okay, sir. So, let me read it. Co expects to pay an additional 12 days leave of sick pay as a unused entitlement that accumulated as at 20X8. That is the 1.5 times the 8 employees. Okay. The unused sick leave equal to 12 days of sick pay should be recognized as a cost and related liability in the period in which the entitlement arises, which is 20X8. Yes, sir. Mr. Enaro and Mr. Norudin, perfectly, this is what you described earlier. Thank you, Comrade.
Okay, to wrap up our discussion, let us now look at profit sharing as part of short-term benefits. But I told you there's an element of it that spans to other long-term benefits. Okay, over to you, Akifolayin. Read this and superintend the question, and let us see whether you guys can prefer the solution. And that will demonstrate our understanding of short-term service benefits and its accounting.
Profit sharing or bonus plan. Profit shares or bonus payable within 12 months after the end of the accounting period should be recognized as an expected cost when the entity has a present obligation to pay it. That is when an employer has no real option but to pay. This will usually be when the employer recognizes the profits and other performance achievements to which the profit share or bonus relates. The measurement of the constructive obligation reflects the possibility that some employees may leave without a bonus. Okay, let's go to the short example here. More Co runs a profit sharing plan under which he pays 3% of his net profit for the year to his employees if none have left during the year. More Co estimates that this will be reduced by staff turnover to 2.5 in 20X9. Okay, required. Which cost should be recognized by More Co for the profit share? Okay, so this is a short example. I think what we need to be focused on now is the part of the present obligation to pay it by the employer. Now, so since More Co has decided that it will pay 3% of his profits as bonus, as profit share for the year, that is, if we have 100% employee, that is, no employee resigned during the year. But the estimate here is that it will be reduced by staff turnover to 2.5% in 20X9. I don't know, please, Mr. Inauro or Miriam, do you have an idea of what this illustration is trying to test? Or should I go ahead with my thoughts?
With your position first.
Okay. So, straightforward. We are sharing 3% of our net profit. If we have full capacity of employee, let us assume that we have 100 employees by the end of the year. That means we are sharing 3% of X as profit sharing. If by the end of the year, the current year, we are dropping it to 2.5% of X, that means X is no longer 100 in this scenario. So we then look for the percentage difference of 3 and 2.5. So that will give us the idea of the number of employees that have left the organization within the year. That is my thought.
Okay, let me just add this, my own little understanding. I think that 3%, if no employee leaves, because the money, the profit sharing is shared amongst all the staff. So basically, if no employee leaves the organization, 3% of the profits will be used as employee cost, as a profit sharing. But because some employees will leave, it's now estimated that it's only 2.5% of the total profit that will be shared among the staff. So basically, the company will accrue for 3% of its 2.5% of its net profit as a staff cost. We accrue for that 2.5% of its net profit as staff cost for the year ended 20x9. That is the way I tend to, which cost should be recognized. Yes, that's where I see it.
So should it be 2.5% or 3%?
Exactly what I'm saying. So are we saying there are two scenarios?
No, it's 2.5%. He said the company estimate that this will be reduced by staff turnover too, because it is looking at historical precedents.
Okay.
So every
Why
year
is it 2.5%? Is because it is your expected value that matters, because you have different state of nature. If all staff stay, it is 3%. But experience has shown you that no year will you have all staff that will start beginning of the year and stay at the end of the year and wait for the bonus to be paid, which means your experience will influence your expectation. And your expectation is based on the probability of occurrence. And that is why 2.5% will be the most appropriate rather than 3%. Does that make sense?
Yes.
Okay, thank you.
Yes, it does.
And this extensively brings us to the end of accounting for short-term benefits. And our understanding of this will lead us much more extensively to understanding that of post-employment benefits. Now we'll move on to post-employment benefits. Accounting for post-employment benefits. Now, we need to first of all understand that post-employment benefits are of two types: defined contribution plan and defined benefit plan. And two, defined benefits plan. Now, if you have come across these terminologies before, can you give us an excerpt? And from there, I can pick up in my discussion. Over to anyone.
Okay, so I want to try. So a defined contribution plan is a kind of arrangement whereby the company over the years try to contribute a little portion of its profits towards the benefits. That is, taking a percentage or portion, depending on their estimation, into a separate cost for the purpose of paying these benefits. That is a defined contribution plan. Well, okay, let me stop there.
Okay, let's see whether this is in tandem with what you have expressed. Can you read this out? Over to you.
Okay, I'm here to see it on my screen.
It seems your network is poor. Miriam. Okay, Nuru, can you read it from your screen? Okay, Miriam, can you read defined contribution plan and let's explain it?
Defined contribution plans are post-employment benefit plans under which an entity pays fixed contributions into a separate entity, that is a fund, and will have no legal or constructive obligation to pay further contributions if the fund does not hold sufficient assets to pay all employee benefits relating to employee service in the current and prior periods.
Now, let me give you a typical example of this, and we'll explain. What's wrong with my pen? Example. Sorry, there's something wrong with my pen. Okay, let me give you an example. I don't know why it's shifting. Okay, let me just continue. Example. There's something wrong with this pen. Okay, wait. Let me write somewhere here. Okay, give me a few seconds to close and open this. Okay, example is the New Pension Act of 2014 in Nigeria. which is also in tandem with the Initial Pension Act of 2004 in Nigeria. Now, what it simply means is that Pension Act in Nigeria is favorably disposed to defined contribution plan, and I will explain what it is. Now, defined contribution plan, what it's simply telling you is that the company has entered into a commitment and a contract with the employee that apart from meeting your short-term benefits and any other long-term benefits, you are equally entitled to benefit that accrues to you, which you will get only when you are no longer in the employment by way of pension. And what that signifies is that what I've committed to do is to pay a fixed amount, which is relatively based on the percentage of your current salary in each period, which I am bound to contribute into a fund. Now, I have no prerogative to manage that fund, whereas you will manage your fund through your own fund managers or your pension managers, which in Nigeria we call pension fund administrators. Now, what that signifies is that once the employer has agreed with you to say 10% of your salary will be contributed by it to your pension fund administrator or to your fund account. Therefore, once the employer has contributed such, that is the all cost to that employer. Now, whether your fund has accretion in value, which means it has increase in value based on fund management returns and also of capital appreciation, or suffer loss as a result of market depletion because of capital market crash and some other things, the employer has no responsibility. The employer has no further obligations towards resuscitating your fund to what's supposed to be. No, because what he has obligation to is the extent to which he has contributed to that fund. And that's why the Pension Act of 2004 in Nigeria is much more inclined towards a defined contribution plan, and which sees the employer to contribute a certain percentage to the fund, even though employee can equally contribute. In Nigerian context, employer will contribute, employee also what? Contributes. Okay, and that is a practical example of a defined benefit, a defined contribution plan. Okay, and that is that. Any question on that, if you want me to expatiate further with practical illustration? Do you all get what defined contribution plan is?
Yes.
Okay, which means the liability of the employer is limited to the amount he has committed to contribute. He is no longer subjected to any further obligation. And in this case, from the perspective of the company or the employer, he has no exposure towards changes in actuarial assumption, or because he has no obligation towards managing the fund. Rather, his obligation is constrained on it making contribution to that fund. And later on, we'll get to the accounting. But first thing is that we are trying to discuss what a defined contribution plan is. Now, how does that differ from a defined benefit plan? Who can explain? Who can explain? Over to you guys.
Okay, from it just, I think it should be just the another aspect of this defined contribution. This one, the employer is the one that makes the contribution into a fund that is basically managed by the employer. And that benefits the defined benefit. There is a particular benefit that the employee is supposed to collect, a specific amount. The employee is supposed to collect at the end of the employment. So any shortfall in that defined benefits must be made up by the employer. I think that's my understanding of that. It should just be the second version of that one.
Okay, I'll come to that. But before going further, Odum, can you read this summary on defined contribution plan before I move further to discussing defined benefit plan?
Defined contribution plans are post-employment benefit plans under which an entity pays fixed contributions into a separate entity, that is a fund, and will have no legal or constructive obligation to pay further contributions if the fund does not hold sufficient assets to pay all employee benefits relating to employee service in the current and prior periods. Defined contribution plans. With such plans, the employer and possibly current employees to pay regular contributions into the plan of a given or defined amount each year. The contributions are invested, and the size of the post-employment benefits paid to former employees depends on how well or how badly the plan's investments perform. If the investments perform well, the plan will be able to afford higher benefits than if the investments performed less well.
Okay, thank you very much. Now, how this differ from defined benefit plan is this. In defined benefit plan, the employer has equally not only assumed responsibility for contribution, he has also assumed responsibility for managing that fund. What it simply means is that instead of shifting the burden of managing the fund to another party, he's taking that burden. Why is he doing so? Because depending on how he managed that fund, and he has have an agreed benefit, he has said it's going to pay to employees, and that benefit is agreed. It then means that how he contributes to the fund is not necessarily the business of the employee. And to maximize his own personal benefit as a company, he will decide to manage the fund in such a manner that instead of contributing more, he will be contributing less because he can invest those funds in yields, market yields, or instruments like shares and etc. that can generate more returns. And the more returns you generate, the less contribution you make. Which then means that if the employer has decided to take such a risk of investment of those funds, and that he has agreed with the employees the amount that they will be entitled to, rather than agreeing on the amount he needs to contribute, but he has agreed on the amount they will get at retirement or at the point of exit. In that situation, we will tell you that what we have is a defined benefits plan. And invariably, this plan will consider the size of post-employment benefits as determined in advance, which is the benefit. For example, how do they determine the benefit? A company might tell you that you are entitled to this benefit from year 10 or from year 5. For example, they might tell you your gratuity, your pension, you are entitled to it from year 5, which means once you have clocked 5 years, you are already pensionable or you are entitled to gratuity. And what that presupposes is that in year 5, the company might tell you that you are entitled to 5% of your annual salary for the number of years you have worked. And they might tell you that this will continue to increase up to your final year of service. Probably your maximum year of service is 30 years. Which then means that if you have spent 8 years What they are telling you is that your current salary as at the time you exit in 8 years times 10% times number of years you have worked will form your benefit. Which means what is defined is your benefit you will get out of that company upon exit. If you have spent 20 years, they are saying that you will get 10% of your final salary at the level you exited times 20 years you have been in service. These are practical examples of how benefits are defined. And these are defined ab initio, that is upon your contract of employment. And that is what it is. And in that vein, I want Marian to more or less read this up and let us further expatiate on it. In line with the requirement of IAS 19, paragraph 26 to 30. What does defined benefit connote? Over to you.
Defined benefit plans are post-employment benefit plans other than defined contribution plans. With these plans, the size of the post-employment benefits is determined in advance. That is, the benefits are defined. The employer and possibly current employees too pay contributions into the plan, and the contributions are invested. The size of the contributions is set at an amount that is expected to earn enough investment returns to meet the obligation to pay the post-employment benefits. If, however, it becomes apparent that the assets in the funds are insufficient, the employer will be required to make additional contributions into the plan to make up the expected shortfall. On the other hand, if the fund's assets appear to be larger than they need to be, and in excess of what is required to pay the post-employment benefits, the employer may be allowed to take a contribution holiday. That is, stop paying in contributions for a while.
Okay, now let's now get to accounting for those two kinds of post-employment benefits.
Sorry, I wanted to ask, please,
Yes.
for defined contribution plan, I'm just trying to look at like in reality. So the companies pay into maybe like a PFA to manage the funds. I'm just saying, so if, for example, after 5 years, I'm out of work, or maybe after 10 years, I'm out of work, and maybe my pension payment was meant to be like 1 million. And then, so are you saying because probably there was a mismanagement by the PFA, they can pay me 600,000 and I won't be able to, probably there will be no obligation for them to pay me more, or there's nobody for me to complain to? I'm just asking, like, if that's what happens in reality, they can just say what they have to pay is 600K and not 1M.
Okay. First, we are not talking of mismanagement. Issue of mismanagement, fraud, embezzlement is a serious and grave issue, which will be handled based on the provision of the law, depending on the country you belong. We are not talking of mismanagement. We are talking of management of a pension fund where your 1 million, imagine the employer has contributed 1 million for you. At the point of retirement, your 1 million might have been 1.7 million, which means return has come in. Your 1 million might have turned to 900,000 because where they invested into, there were loss of value. They invested in shares, and shares has crashed from 20 naira to 15 naira. That affected your value. That is not mismanagement.
Yeah.
Do you get what I'm saying now?
Yes.
Even though in Nigeria, it is rare for your fund value to fall below your contribution. Ask me why.
Why?
Okay, the reason being that the Pension Act in Nigeria has restricted most of the investment vehicle that a fund administrator can invest in. Much more of a pension fund should be invested in, one, gilt-edged securities, which are government securities,
okay,
such that there is no risk of default and it has a return. Two, invest in corporate bonds. Do you get it now?
Yes.
Those high quality bonds. Invest in real estates.
Okay.
Invest in agriculture. I think in Nigeria, you can't invest more than, is it 5% or 20% or whatever, which you can check from the Pension Act of 2014 in shares. which are the volatile ones. Do you get what I'm saying now? Therefore, in Nigeria, it is practically impossible for you to have it to be lower than what was contributed.
Okay.
Are you getting? That's why if you have checked your pension statement, you see that your value is increasing based on returns. And that is that. Okay, that addressed that. Now, we want to account for defined contribution plan. How do you account for it? Very straightforward. The accounting is very straightforward. And done on the basis of accrual concepts. And what is that? At end of each period, usually monthly, but it can be annually as the case may be based on each jurisdiction. Whether you have money or not, the pension of an employee must be recognized by way of debits as part of staff cost. The component of what? Employers, and where necessary, because not in all jurisdictions will employee also contribute. Employers and employee pension cost. And you credit your pension payable account with the pension amount as defined. Upon payment, or what you know as remittance to the PFA, to the pension fund administrators, what you do is to debit the liability account. Remember, this is a liability account. The pension payable account, signifying that you have defrayed your obligation by way of payment, debit your mode of payment, which in this case is bank. With what? With the actual amount paid. If you're unable to pay all, it then means that you still have balance in your liability. Very simple for defined contribution. And what happens to your pension fund is your own business as an employee. Employer obligation is limited to the amount required to be contributed, less the amount that has been paid. Any question on that? Does that make sense to us?
Yes.
Okay, now where the bulk of the work is, where IAS 19 focus much more on, is the defined benefits. And I'm going to take time to demystify that. Okay. Now, the first thing is this. Accounting for defined benefit plan. First, we need to understand if the plan is either A, funded, or B, unfunded. Now, in primary sense, when you say something is funded, and the other spectrum, you say is unfunded, what do we mean? Who can explain? Funded and unfunded status of a pension plan.
Okay, so I think funded will mean like an amount has been set aside primarily for the purpose, in this case, pension, so that at every point in time, for any form of withdrawal, all you need to do is to go into the fund and withdraw. But if it is unfunded in status, it means it is at the time of having to withdraw that the portion of it will then be contributed into the fund.
Thank you. When you say funded, it means not only that you recognize your defined benefit obligation, but you also create a plan what? Asset. And I will explain. But under funded, unfunded, what you only have is defined benefit obligation without having to fund an asset that will be used in the future date to settle that obligation. Now, note, PA means plan assets. That is, the assets or investments created to settle the obligation as they fall due. Why define benefit obligation? Represents the liabilities, the plan liabilities as estimated by an actuary based on actuarial assumptions and financial variables, which we are going to discuss. That is where the great work is. Okay. Which means funding a defined benefit plan means you have a dedicated investment vehicle or investment account, whether as a pool, that is held in trust. This is held in what? Held in trust. The word trust will come back to it for the employees. in the scheme. And this will be ring-fenced outside the asset of the company. Even though it's managed by the company, but it's never an asset of the company by any means. And such assets held in trust are extremely protected by the law, which means even if the company go bankrupt, that asset cannot go bankrupt with it because that asset is not the asset of the company. It is held in trust in a fiduciary capacity on behalf of the employees. And that is what you need to take note of at every point in time. Okay, when you have such, you say the fund is what? The defined benefit plan is funded. Otherwise, if there's no dedicated plan assets, thought that it's only for the company as at when payment is due, they go into their own operational cash flow and settle. Such fund is unfunded because there's no dedicated account. And the problem with unfunded is that if the company has cash flow issue, you won't be able to settle. If the company go into bankruptcy, the employees are likely going to lose their benefits because it is what is realizable that can be used to pay. But if it is funded, which is usually the requirement of many laws of different countries, like in Nigeria, for those that are what they call closed health pension scheme, they are mandated by the requirement of the law based on the new Pension Act of 2014 to be funded. Now, when you fund a plan, a funded plan could result in these three, could give rise to either of these three. One, it could be overfunded. It could be fully funded, which is very rare, and I'll tell you why, and can be underfunded. Now remember, funding plan means you have both the plan assets, not by just accounting, but by creation of value in its real sense, and you have recognized for accounting purposes your obligation towards that plan. But where can we say a plan is overfunded? Where can we say a plan is fully funded? When can we say a plan is underfunded? Over to you guys. I'm awaiting your responses.
Okay, if I think overfunded and underfunded we based on the actuarial valuation. So
yeah, everything is based on actual valuation. But when will you say?
No, what I'm saying, I'm saying
plan,
yes.
Post-employee plan is funded. When do you say that funding status is overfunded? When do you say it's fully funded? When do you say it's underfunded?
Yes, I was just trying to say that I may not be right, but I'm trying to say that yes, everything is actuarial based. But if the actual liability calculated, the present value of the liability, yeah, vis-a-vis the amount of money that is set aside, I think that is why I'm looking at it. So it depends on the liability, the liability and the money, and the liability is definitely going to be calculated by the actuary. That is way. So if the liability is less than the money set aside, I think it will be
okay. It's not about money set aside. When you compare the plan assets with the defined benefit obligation, and you find out that the plan assets measured at its fair value is higher than the defined benefit obligation measured at its present value. What does that mean? It means you have more assets sufficient enough to pay all of that liability and you still have balance in the assets. That's what it simply means. Conversely, when the asset cannot fully pay the obligation as it falls due at the present, you say it's underfunded. It is very rare to have the asset exactly to have funded the liability. Not that it's not possible, but what it means is that immediately you are carrying out the actuarial valuation, probably at the end of the year, prior to a new year, your shortfall was contributed immediately, which is very rare because most companies wait until after the end of the year in order to have sufficient information currently and for future expectation to carry out such valuation effectively. That is why I do say that it's rare to have a fully funded, but what is close to funding might be overfunding or slightly underfunding, which is totally different from unfunded account. Unfunded means you don't even have contribution at all, not that the contribution is insufficient. Yeah,
So,
you are trying to say something?
yes, I wanted to ask that this defined benefit plan that is funded, the fund simply means that this money is set aside. This money set aside is usually invested?
Yes, that's what we are saying now. How will you set aside money and you keep it idle? That does not satisfy any basic principle of financial management. Even as a company that needs money for operation, once you're able to project your cash flow requirement for a short period, any amount you have in excess of it, what do? You put it in short-term securities in order to maximize return. No finance manager will now be setting aside money for pension payment, not for pension contribution, but pension payment, and you just be keeping it idle. Therefore, what is now the essence of you trying to manage the fund towards maximizing benefits, which will allow you to have future reduction in your contribution? Do you get the logic? As you move on, you see the reality of it.
Okay, in that case, so where does actually come into that asset? Because it actually can come into the liability aspect, but the assets, liability cannot. They come into the measurement of the assets, the plan assets.
Okay, we'll get there. We'll get there. But let me give you a clue before we get there. The clue is this. Plan assets, not plant, sorry, plan assets. Are to be measured at fair value at each reporting date. 2, define benefit obligation are to be measured at each reporting date at present value by an actuary. That is the first clue I'm going to give to you, but we'll develop on that, which means actuary is much more inclined towards valuing the defined benefit obligation, but they play a role with respect to the planned assets, especially with expectation for the future contribution, which will fall into what a fund manager, like normal portfolio managers, will act on and trying to place their portfolio in different positions or manage their portfolio in its entirety. Does that give you a small clip? Because we are going to go down into how do we fair value plan assets, and majorly, how do we present value defined benefit obligation? Is that okay, sir?
Yes, sir.
Now, it is important to make a clear distinction between the following. Funding means contributing to a dedicated trust account, which is an investment account for the sole purpose of meeting future obligation of the defined benefit obligation as a default due. Why accounting varies with respect to just mere accrual principle, and that is that. Any question? Any question? Okay, if there's no question, I'll give us 5 to 10 minutes break as we will now go deep into ascertaining what is our planned assets and its measurement, and what is our planned liabilities and its measurement with respect to defined benefit obligation. Okay, welcome back to our discussions. And now we will go deeply into discussing on the planned assets and on the defined benefits obligation with respect to the evaluations and the accounting. Okay, how do I start? Okay, let me start like this. Let me start from the planned assets. The planned assets comprise of the following: one, investments in shares, or what we call stocks, investment in bonds, government and corporate bonds, usually corporate bonds of high yield, investment in treasury, bills, and other money market instruments, such as fixed deposit, commercial papers, etc. Investment in real estate investment trusts. Investment in real estate itself, usually limited in nature because of most of the assets must be highly liquid. Other acceptable investments. But most laws or countries prohibit investment in highly speculative instruments, such as derivatives and some other investments, or investment in physical items that might take a lot of time to realize. That is why here I emphasize the word limited for real estate. Rather than invest in the real estate itself, they invest in a vehicle that deals in the real estate so that they can easily sell such shares and move on. And other acceptable investment might also be holding some little amount in cash in meeting current obligations. Now, IAS 19 requires the planned assets to be valued or measured at fair value. Now, the fair value definition in this case will be in tandem with what we have under IFRS 13. Okay, now what do we mean? The fair value as at the reporting date could be broken down as thus. The fair value at the beginning of the year, let's say 1 million, and this will be increased by the interest income, which is the expected return from it. And this is determined by way of applying the discount rate on the opening balance, assuming there's no intermittent cash flow during the year. And we're going to explain it when we get detailed on this discussion. And let's say the discount rate is 10%, therefore this is 100. And this will also be increased by contributions to the fund, which is usually the employer, and sometimes employee also contribute to the fund. And such contribution will be invested immediately when necessary. Now, where there is benefit paid, this benefit is paid to retirees upon retirement or upon exit. That will reduce your value. Let me say 120. Also, it's possible that you make settlements. Settlement made, which is upon curtailment, which we are going to explain, of a plan. I bring up to this. Now, all of this, naturally, all things being equal, is expected to be your fair value as at end of the year. I want somebody to calculate it for me. But independently, the portfolio manager or the actuary, as the case may be, because actuary is also an investment expert, they can independently value it. Equally, portfolio managers or investment managers can equally value it. That is not a big deal. will independently, at the end of the year, carry out a fair valuation and obtain the fair value as at the same date. And the difference between these two represents remeasurement gain or loss. On the planned assets. Can somebody sum it up?
The first one is 1,250.
Okay, let me also check. $1,250. Let's assume independently it was valued for 1,300. Therefore, there is a gain of 50. And that is your difference between the expected fair value of the planned asset at the end of the year and the actual. I want you to peruse this. Who can interpret this? Who can explain it further so that I can know that you guys got everything right?
Okay. Considering the fair value of the planned assets, we consider the fair value as at the beginning of the year. Then on that plan assets, we consider the interest income that we are going to get on the assets for the year, which is 100. Then the contribution by the employer and employee, we consider it. Then on the existing plan assets, we consider the benefit that has been paid to the retiree, which serves as deduction to the plan, to the value. Then we consider the settlement made upon curtailment, which also serves as deduction. Then we get the fair value as at the year end, which is 1,250. Okay, 1.2 million. I think the number is in thousand. Then we now get the actuarial value of that planned asset, which the actuarial gave us the value of the assets to be 1.3 million. Now, considering the actuarial value and what we calculated, we discovered that we have a remeasurement gain of 50,000. That is the interpretation.
Okay, any other contribution?
I just want to ask a question. For instance, if an employee makes additional voluntary contribution,
yes,
also be reflected here, whether it was later withdraw or it was an additional contribution, the inflow and outflow, can we reflect it in this schedule.
Your voice is not clear enough and it's very low.
Yeah, it's because of the.
We can't hear you. We can't hear you. We can't hear you. I think something's wrong with your mic.
I don't know.
Okay, I think it's better now.
Okay, what I'm saying is that there's a background noise that comes and goes, so I don't want to disturb the class. So this is it. I'm asking if an employee makes an additional voluntary contribution, can it be reflected in this schedule?
Yes, that is what we said here. Employer and employee, mostly employer, but where the scheme permits employee to make contribution, it will also be there.
Okay.
Now, remember, as I said earlier, your planned asset constitute asset held for long-term employee benefits. All of this and other acceptable investments, such as qualifying insurance policies. Take note of that. Now, this is it. Now, expected returns. That is the interest income. Will be determined as at year end based on the opening balance of the planned assets.
Expected returns.
Subject to inflows and outflows of cash during the year and the discount rates. I will explain. What we are saying here is very simple. The expected return. What is the expected return? Let me highlight it in green. Why is it not coming up? Okay, let me just use this green. This return is determined by applying the discount rate on the opening balance of this 1 million naira. But this is premised on the fact that every other cash flows, inflow and outflow that we have considered only happen at the end of the year. If they happen during the year, we must factor it in computing our interest, because cash flow that you added to it during the period should have accrued interest. Cash flow you remove from it by way of settlement or benefit paid will not have accrued what? Interest. But for examination purposes, you only apply the discount rate on the opening balance. That is that. Later on, we'll answer the question of how do we determine the discount rate? That is a question begging for what? Answer. We are going to answer it when we get to the defined benefit obligation, because the same discount rate we used in obtaining the present value of defined benefit obligation is the same discount rate we are to use in obtaining the expected return on the planned assets. And we are going to discuss that extensively. And what can we use as a surrogate if the discount rate is not readily available. We are also going to discuss that as we move on. Any question on that? That is on the plan what? Assets. And take note, the plan asset can be fair value either by the portfolio manager or by the actuary, because an actuary is equally more or less an expert in portfolio valuation. Okay. Now let's now move to the next one, the defined benefit obligation. Defined benefit obligation is a plan liability of the scheme as maintained by the organization. And in that regard, it is going to be valued
Hello, sir. Please mute your screen, please. Mr. Shelly,
Yeah.
please mute, please.
Sorry, is the network better now? Can you guys hear me?
Yes, welcome back.
Yes, we can hear you.
Sorry, it seems my village people are at work. Okay. Sorry, I need to stabilize the network. It seems it's bad. Give me 1 minute. Okay, sorry for the bottleneck earlier experience with the network switch. Now, defined benefit obligation. How do we come across that? Now, defined benefit obligation is the obligation within the pension plan as maintained. And the pension plan we are talking about here is a defined benefit plan. Now, the methodology, the actuarial methodology so adopted by IAS 19 is the projected units credits method. And don't be frightened with the name, very straightforward. And I will explain it as time goes on. And this methodology measures the present value of the defined benefits obligation, DBO, as does. Remember, this will be done by an actuary. Let us assume, as at the beginning of the year, the plan is fully funded. Fully funded means, if you remember what we discussed here, it means the plan asset measured at fair value and the defined benefit obligation measured at present value are equal. Which means in this case, since the fair value of the plan asset is 1 million, I will assume, for simplicity's sake, that the present value of defined benefit obligation as at the beginning of the year is also 1 million. Now, this will be increased by current service costs, which we are going to explain. Let's say our current service cost is 130. This will be increased by interest cost, which is similar to interest income, which is based on discount rates. And the discount rate will also be based on this opening balance, subject to variability in the cash flow during the period. Let's say it is at 10%, which is 100. This will be impacted by plus or minus issues that borders on past service costs. We are going to explain that. And this is not usually always present at all times. I'll use the word or the phrase, if any. If any means it could occur, and it only occur under certain conditions, which we are going to explain. And it could bring about increase in the liability or decrease in liability. That's the word plus or minus. That's what it stands for. Let us assume it brought about increase in this case by 40. Also, there could be okay. Okay, let me shut this down and restart my Word document. Let me shut it down and restart my Word document. Okay. I restarted it. Will be reduced by the benefit paid. If you remember, the benefit paid will reduce the assets because the assets have to be realized to pay the liabilities, which means the same 120 is what we deduct. Benefit paid to retirees is 120, and where we have settlements as transferred arising from curtailment will be used to reduce further the obligation, which we are going to explain. We'll pick all of these variables one, and I will try to explain to you that exactly commensurate out of curtailment, which means you can curtail a liability of 25, but you settle it with 30, which means there is a loss upon curtailment. I will explain that.
Sorry, your
This should give us,
areas,
with respect,
your write-up is not showing on the whiteboard.
to the present value. It's paused. It's paused. It now. It's paused. Now, where I stopped was benefit paid to retiree is 120. And this 120 is similar to this same 120 because the amount due is the amount paid in most cases. But for settlement, the amount settled or paid may vary from the value that was curtailed. Usually, companies pay more than the value curtailed. And that is why you have, in this scenario, 25,000 was transferred as liability arising from curtailment, whereas 30,000 was actually paid, which means you pay more than your liability, which means there's a loss arising from curtailment. And sometimes you might pay less than the liability, which gives a gain arising from curtailment. And I'll explain what curtailment is and how such settlement arises. Okay, invariably, our expected present value of the defined benefit obligation as at the end of the year is this. We'll compare that with the actual liability as measured at present value based on the projected unit credit method by the actuary as at the end of the year. The difference between the two will give you the measurement gain or loss on actuarial measurement of the planned liability. Simply put, it gives you the actuarial gain or loss on the planned liability. Now, who can sum this up and let us see what it is? 1,000 plus 130 plus 100 plus 40 minus 120 minus 25. This is this. Let's assume at the end of the day, our liability is measured at this by the actuary. It then means that we have remeasurement. The measurement loss. Or gain on the defined benefit obligation. This is otherwise known as actuarial gain or what? Or loss. Actuarial gain or loss. How much is this? That is 155. Any question on this? Any question on this? Any question on this?
Yeah, it's just that you're yet to explain the curtailment and unit credit method.
No, we are coming to that. I'll not even explain all of these components one by one. All of these components one by one will be explained. One by one, they will be explained, okay? And this is just to draw your attention to what we mean by projected unit credit method. And we're going to explain them one after the other. Okay. Now, there's something I want to point your attention to, which skipped my discussion, was what qualifies as an insurance policy. Remember, we said qualifying insurance policy. A qualifying insurance policy, I want somebody to read this. What kind of insurance policy qualifies you? Somebody should read. Shegun, over to you.
Please, there's noise from the background, a lot of noise.
Okay, a qualifying insurance policy is an insurance policy issued by an insurer that is not a related party. Sorry. A qualifying insurance policy is an insurance policy issued by an insurer that is not related party. as defined in IAS 24 related party disclosures of the reporting entity. If the proceeds of the policy A can be used only to pay or fund employee benefits under a defined benefits plan, and B are not available to the reporting entity's own creditors, even in bankruptcy, and cannot be paid to the reporting entity unless either one, the proceeds represent surplus assets that are not needed for the policy to meet all the related employee benefit obligations, or two, the proceeds are returned to the reporting entity to reimburse it for employee benefits already paid.
Okay, thank you very much. Okay, which means not necessarily all insurance policy will qualify. The one that will qualify is the one as defined under the requirement of IAS. Okay. Any questions so far? Now we'll pick all of this one by one.
Hello, Shogun. Please wait, please.
Oh, sorry.
We'll pick this one by one. Now let's start with interest income and interest expense or interest cost. In the profit or loss of an entity, IAS 19 requires an entity to report the net interest cost. Or in extreme case, the net interest income as thus. What is your net interest cost or income? It is your interest cost arising from your defined benefit obligation, which in this case was this 100. You first net it off against your interest income, that is expected returns from planned assets, which in this case was this 100. They coincidentally are 100 because one, the fair value as at the beginning for the planned asset and the present value as at the beginning for the defined benefit obligation are both 100, are both 1 million. And remember, I make mention of the discount rate, that the discount rate you apply is the same discount rate that you apply for both the plan assets and the plan liability. Which means in this case, when you net it off, it is a zero. Your net interest cost. Which means if our opening balance has not been the same, therefore this will have been net of a cost if the interest cost is more than offsets the interest income, or it will have been net interest income if the interest income is more than offsets the interest cost. Okay, and we are going to see that practical situation as we move on. Now, the question then is, what is the appropriate discount rate to use? The discount rate to use is a function of the following. Is a function of one, government bond, which means it must be gift edge. Instruments. Gilt edge instruments are instruments that are risk-free. Let me emphasize. Risk what? Free instruments. That's number one. Number two is that it should be of a similar my pen is misbehaving. I think my pen is tired. Even though me, human being, I'm not tired, yes. Similar sorry. Let me open the document. Similar is of a similar maturity to the weighted average remaining lives of the plan, okay, of the scheme. Okay, these two factors, remember, the first factor is that is a government bond. The second factor is the government bond is of a similar maturity, which means if the average life of the fund to its maturity is 10 years, you look for government bond that is roving around 10 years. It might not be exactly 10 years. The government bond you have might be of a 9-year or 9.5 years, or of 10.5 or 11 years, which is something closer to it because it's difficult to have exact. And the average remaining life of the plan is to say, there are some people that are 10 years to retirement. Some are 8 years to retirement. Some are 15 years to retirement. The average life is what you use to determine. What is the average life of the plan? If it's 12 years, you look for bond of 12 years, and that is that. Now, there's a clause here. The clause is, what if you don't have government bond? What if? There are no government bonds of close or closer maturity, or even there's no even government bond at all. What will happen? In such a case, you take a surrogate. And what is a surrogate in this case? You replace such of the government bond. And what is a surrogate? You seek for a high quality corporate bond of similar maturity. What that signifies is that high corporate bond is of high grade, which by nature is closer to being risk-free, if any. Which means you now look for bond by way of Moody rating, or by way of Fitch rating, or by way of Standard & Poor rating, or in Nigeria by way of Augustus and Co rating, that is of the highest quality, probably AA, A, A++, and etc., depending on the nomenclature of the grading, but of the highest grade. And you look for the one that has similar maturity to the weighted average remaining life of the plan. That the yield on such a bond is what we adopt, which means in conclusion, the discount rate to be used is the yield as at the reporting date for a government bond of similar maturity, or where not obtainable, you adopt the yield, that is the market yield, or what you call yield to maturity, of a high quality corporate bond. As at the measurement date, usually the reporting date. Does that answer? That should answer our desires. Yeah. Any questions so far?
Okay, so I think the same thing still applies if the risk-free rate is negative, because here in France, there are times that we have negative risk-free rates.
Okay, thank you very much for that. Now, can you tell people when interest rate is negative or yield is negative? Can you explain what it is to people so that people can understand that language, because it's not common to our environment?
Yes, in fact,
I'm
I'm aware of risk-free rate of 11%, 12%. You know, that is why we rush to buy treasury bills and government bonds in Nigeria. But when we have like a negative risk-free rate as it obtains here, that is when you're not getting returns from your investment. It means when you invest into the government bonds or treasury bills, you are even going to get losses. It's going to be
not losses. You pay interest.
You pay interest. Yes, that is what I meant to say.
On your own deposit, you pay interest for
Yes.
the bank or for the government to have access to your deposit.
Yes.
Why do you believe such happen in such an environment? What is the government trying to do with its monetary policy?
I want to believe is a way of mopping up excess liquidity from the economy.
No, not mopping up liquidity. Where government is discouraging savings, it means there's no liquidity. You should go in and invest in real sector instead of dumping the money in money market in banks. Go and buy shares so that company can invest in operations.
I also want to think that is the reason why most of the investors here, they prefer to take their money to other economies where they can get enough returns on their investments.
It varies. Investors will always look for alternative source of investment where you get the highest return. They are prostitute in nature. If the return is on money market, wherever it is in the world, they take it there. If the return is on real sector, they take it there. You can say that. Therefore, they are rational investors. They are not behavioral. They are not interested in, they don't have any attachment. What they have attachment to is the return, wherever the return is. That's why you see people moving money across the globe. They call such portfolio investors. They have no interest in developing something for long. What they have interest in short-term returns, and they get it anywhere it exists. Which means in the case you have a negative return, it then means you can't use government yield. You have to look for the one that has a positive yield. The worst discount rate you might have used is the 0%, which I don't think is practicable. Does that make sense now? I think that has more or less given us more exposure about the discount rate. Now, which means we've dealt with interest income and interest cost, because both are based on the same discount rate. But what differs is that interest income or expected return is the discount rate applied on the fair value of the planned asset at the beginning for examination purposes, and interest cost is based on the discount rate on the present value of the defined benefit obligation at the beginning. Now, let us now come to contribution. What is contribution? As we have discussed it extensively, your contribution will automatically be what the employer has put aside as a way of increasing the value of the planned assets at a particular period. And it might be contribution of both the employer and that of the employees, depending on the arrangement of that scheme. Otherwise, contributions is usually of the employer only. Okay, any question on that? Contributions are majorly of the employer and sometimes may include that of the employees based on the scale. Which means, in summary, contribution to defined contribution plan should be recognized as an expense in the period they are payable, except to the extent that labor costs may be included in the cost of asset. We are going to get to that level as we move on. Sorry, okay, I think I will not use that as the contribution I tried to demonstrate to you. Okay, that contribution I showed you earlier is more or less that of a defined contribution. Therefore, I'll take this off and just consider what I've written as contributions. Okay. What next? Benefit paid. These are payments due to exited employees upon retirement or voluntary resignation or otherwise by way of periodic payments, which can be pension or annuities, or can be lump sum payments. Lump sum payments in Nigeria, it is like gratuity, which means the benefit pay can be lump sum, which is much more of pensions or annuities, while lump sum payment is much more of bulk once you collect all your money, and that is gratuity. But the one you collect every month, every quarter, or every year is synonymous to pensions or annuity payments. Okay, that is the benefit paid. It is the actual cash flow. It is the actual cash flows paid to retirees. Let me put it in that case. And you find out that the benefit paid will reduce the planned assets because you liquidate your assets and use it to extinguish your liability, which is what I was trying to do earlier. Let me highlight it here. The same amount. Now, the next one is settlement made upon curtailment. Now, what is curtailment? What is settlement? Who has come across the word curtailment? When you say curtailed the plan, what does that mean? When you curtail a plan, what does that mean? If the organization you are operating in now says you want to curtail a plan, what does that curtailment mean?
Is it limit? Like I'm trying to look for something, limit a plan or stop something from getting bigger.
Okay, it seems you are making sense with it. Can you demonstrate it practically? Or use practical illustration?
Okay, I'm thinking, for example, if there is a planned asset that was proposed to be about 40 million, if the contributory plan into the planned asset, you can decide to curtail it by maybe at the point it gets to 39 or 40 million, you just decide to stop this thing for a while. That's what I'm thinking. Stop the contribution.
Okay, now let me give you a practical aspect of curtailment. Okay, curtailment might be in total, but I want to speak with curtailment that is not totality. Imagine your company has 4 divisions, and one of the divisions has been loss-making. And from the performance management perspective, the board has risen to a decision scientifically and economically to shut down the 4th division, the loss-making division. And what it means is that the staff in those divisions will have to be set redundant, or the company has decided to sell that division to another company, which then means that the staff have to be transferred out of that company. And which then means that their involvement or their continuous participation in the defined benefit plan will have to be curtailed. We have to be limited, or we have to be totally taken out, which means they are no longer in that scheme. But you need to settle them up to the date they were curtailed. Which then means that a curtailment occurs when an entity significantly reduces the word significant, not just minor, because minor reduction might be by way of what we call modification to the plan. But that's not what we're talking about. We are talking about a situation where an entity significantly reduces the number of employees that is covered by that plan, either by way of deleting a product segment, shutting down a business division, transferring or selling of that division to external parties, or whatever reason it may be, that you stop the continuous participation of some set of employees in the plan going forward. And that's what we mean by curtailment. And every curtailment will lead to settlement. And what does settlement mean? Settlement means that you need to pay them off as they extinguish that plan, even though that plan still exists. But you are taking some people off the plan because of one reason or the other, and you have to pay them off. Most times, when you curtail people out of a plan, you need to compensate them for them to be able to accept. Otherwise, people will revolt. That is why you find out that most times you pay more as settlement than the actual liability curtailed. And that is why you find it here, where you find out that here the settlement made upon curtailment was 30,000, whereas the actual liability curtailed was 25, which means in this case, there was a loss on curtailment. Conversely, a situation might come where there might be gain on curtailment, mostly if that curtailment is self-induced by staff. Staff that see that a company is struggling and the ability of the company to pay in the future might be limited. Such staff might be interested in, okay, let us curtail and pay us off now, which means if that is instigated much more by staff, the company might negotiate to say, okay, if I'm to pay you off now, I don't have up to that. Your liability is 10 million. Or my liability to you is 10 million. Okay, I can only meet up 9 million. And if the staff so agree, such curtailment of 9 million will result in a gain of 1 million to the employer because he has settled a liability of 10 million in full and final settlement with 9 million. And which means reverse will be the case. Here you have, let me say 25 million settlement in cash, but you have liability of what? 30. And that is what it is. And on that note, I can put this up and I want somebody to read this out. Can somebody read this out? Can someone read this out?
Settlements and curtailments. A curtailment occurs when an entity significantly reduces the number of employees covered by a plan. This could result from an isolated event, such as closing a plant, discontinue an operation, or the termination of or suspension of a plan. Past service costs can be either positive if the changes increase the obligation, or negative if the changes reduces the operation. The 2018 amendments to IAS 19 provides clarification that when the net defined benefits liability or asset is remained as a result of a plan amendment, curtailment or settlement covered in point 1 below. The updated actuarial assumptions after taking account of the effect of the amendment. Curtailment or settlement should be used to determine current service costs and net interest for the remainder of the reporting period. Gain and losses on settlement. A settlement occurs either when an employer enters into a transaction to eliminate parts or all of its post-employment benefits obligation other than a payment of benefits or benefits to or on behalf of employee under the terms of the plan and included in the actuarial assumption. A curtailment and settlement might happen together. For example, when an employer brings a defined benefit plan to an end by settling the obligation with one-off lump sum payments and then scrapping the plan.
Okay, show the entry. Hello?
Okay, yeah. The gain on loss on a settlement is recognized in profit or loss when the settlement occurs. We debit present value of obligation as advised by the actuary and credit fair value of plan assets, any assets transferred. Then we credit cash paid directly by the entity, and we credit or debit profit or loss difference.
Okay, now what that simply means is this. For example, in this question of ours or illustration, you see that settlement made was debited to the plan assets, which is the entry you just read, to the tune of
30,000.
credited to the plan asset to the tune of 30 million. Whereas 25 million was debited to the plan obligation or liability to the tune of 25. What then happened is that you paid cash of 30 for liability of 25. Therefore, what has happened? The gain or loss on curtailment and settlement that have arisen from it is as follows. Settlement made by cash, settlement made by cash, was 30. The defined benefit obligation curtailed in the year was 25. Is there a gain or a loss from this? Have you made a gain or have you made a loss? Liability you owe is 25, but you settle it at 30. Is it a gain or a loss?
It's a loss.
Therefore, loss on curtailment and settlement will be reported in your profit or what? Or loss. To the tune of what? 5. Does that make sense now? That is what that is telling you. And we're going to report that within the employee benefit costs in our profit or loss. I think that has further explained this aspect of benefit paid, settlements made upon curtailment, and also this. Now, let's now go to current service costs. Those are where the job is. What is current service cost? Current service cost is the incremental amount that impact the present value of your defined benefit obligation, or simply put, an increase in the present value of your defined benefit obligation that is solely attributed to spending that is for each staff contributing additional year of service. What simply means is this: if you go back to our narrative at the beginning, we said that if the plan by the company is that from when you clock 5 years in the company, you are entitled to gratuity payment that is equal to 10% of your final salary, annual salary, as at the point of exit. Okay, subject to the number of years you have spent in service. That is what we mean by current service cost, which means it increases the liability the company has towards fulfilling the defined benefit that have been agreed with you as an employee. Now, let me give you a practical example, or before the example, let me summarize the definition in line with IAS 19. Okay. Can somebody read this for me?
Okay, I'll read. Current service cost.
Sorry, go ahead.
Okay, it's blocked somehow.
Okay.
Okay, current service cost. The increase.
Okay, I just want to take this off. Okay, I continue.
Okay, the increase in the present value of the defined benefit obligation results in, okay, the increase in the present value of the defined benefits obligation resulting from employee service during the period, that is current service cost.
Okay. Now, I'll give a practical example. And I want somebody to explain what it is or interpret what it is. Now, let me assume given that ABC Limited in its contract of employment to Mr. X says after 5 years of service in the company, the employee qualifies for gratuity, which will be paid upon final exits as thus. Gratuity is equal to 10% times years of service times the final annual salary. Now the question then is, kindly estimate the gratuity if Mr. X had retired at A, year 7, when his salary was 10 million naira, or B, year 10, when the salary was 12 million naira, or C, year 11, when the salary was 13 million naira, and finally, year 12, when the salary still remained at 13 million naira. E, this question 1. Based on question 1, kindly determine the current service cost for year 11 and year 12, respectively. Now, I want you guys to discuss this on the premise of our understanding of current service cost and From there, we'll take it up. Over to you guys. I want Akin Folarin to facilitate this and let people contribute. Over to you.
Okay, sir. Okay, so the question before us, how do we approach it? Okay, let's start by itemizing the details in the question. So the policy for ABC Limited is to pay gratuity after 5 years of service. So and gratuity is computed as 10% of 10% times service years, years of service and fixed annual salary. Okay, so we now have different scenarios. Okay, I would like to be writing it down. So, or let me be. Hello, can you hear me?
Yes, we're with you. We're with you.
Okay, I want to be writing it down. Patience. Okay, so hello, can you still see the question, please? I can no longer see the question.
I also cannot see it.
Oh, that must be from his internet connection.
I wrote some things down, so I did some maybe that will work. But my problem is the noise from my background. Hope it's not a problem for you guys.
Okay, let's manage it, please.
Okay,
Let's
all right.
manage
We are
it.
doing a little renovation in our house. So in year 7, it said the salary was 10 million. Are you with me?
Yes, sir, go ahead, please.
So the salary was 10 million in year 7. So we just had to find 10% of 7 years, 10 million. And that gave us 7 million naira. So the year 10, the salary was 12 million. So 10% times that 10 years times 12 million gave me 12 million. So in the, I think year 12, year 11, I think I missed something. I didn't write down the salary of year 11 and year 12. I just did the final calculation. The final calculation of the gratuity for year 11 and year 12 is 14.3 million and 15.6 million. So in computing the current service cost, I did a difference of that 14.3 million for year 11 minus 12 million for year 10, and that gave me 2.3 million. And current service cost for year 12, I started gratuity for 11, and I got 1.3 million. Hello?
You can continue.
Okay, so I think that is all I want to say.
Okay, Akin Folarin.
Please unmute Akin Folarin.
Okay. Oh, thank you, Mr. Sheldon. I said we lost the screen for a while, so you were helping us with what you have jotted down. So the details again, if we can quickly run through it again.
Okay, this is
For
what I said. I computed gratuity for year 7, 10, 11, and 12. Yeah, based on the salary that the man earned in those years, the number of years he had served, and 10%. So in in the 7th year, I got 7 million as a gratuity, 12 million in the 10th year, 14.3 million in the 11th year, and 15.6 million in the last year, which is year 12. So I also tried to compute the current service cost for year 11, which is a subtraction of the gratuity of year 10 minus, from that of year 11. And that gave 2.3 million as a current service cost to be recognized. And for year 12, it's the same thing. The gratuity for year 12 minus that of year 11, we give 1.3 million. So that is the way I went about
That's correct. That's it.
it. Okay.
I didn't calculate it, but you have explained it. That's it. So
Okay,
I
but you can
calculated
still
the
calculate so that
gratuity.
you'll be sure that I didn't make any calculation error.
I didn't do the calculation,
Okay.
but your explanation, the difference between year 11 and 12 give us the gratuity for year 12. So you are correct.
Yes, sir. Over to you, sir. I think Sheldon was able to explain the principle.
Yes, he has done justice to that question. He has done justice to it. So it just is the arithmetic for the gratuity, which he has already said, 10% times years of service times fixed annual this thing. Then the service cost is the difference between the current year and the previous year, which is what he did for year 11 and year 12. So I think he got it accurately.
Hello, comrade, are you on this call?
Hello?
Okay. Okay, I was trying
Yes,
to call
I'm
his
there.
attention.
Yeah, I'm there. Now, what I'm going to do now is to demonstrate it on Excel. I'm trying to bring up my Excel. Okay, let me share my Excel with you guys. Are you there? Can you guys see my Excel?
Yes,
Yes, sir.
I can see it.
We can see it.
Okay. Now let me bring the question forward. This is a question. Okay, I think you can still see it briefly. Okay, let me bring out the variables. The variables are the years. We have year 7. We have year 10. '11, and we have year 12. No problem. Now these are the years. What other variable do I have? Gratuity rates. Gratuity rate is 10%. Again, the gratuity rate can be graduated. It might tell you that within 5 years to 10 years is 10%. Within 10 to 15 years is 12%. But in this case, for simplicity's sake, I agree 10%. Okay. Annual salaries. That means it is 10% across. That is what it means. Annual salary, this is 10 million in year 7. Let me put it in currency. In other years, it varies. As at when it became 10 years, it has increased to 12 million, probably based on salary increment and also levels, probably has been promoted. As at 11 years is 13, probably salary increment. In year 12, it has not changed from that 13. Okay, what other variable do we have? Nothing. Which means A says what? 1A says what is the gratuity for year 7? Year 7 gratuity will be very simple. The gratuity will be 10% multiplied by 7 years, multiplied by the annual salary then, which was 10 million. And in that case, that will sum up to the product of 10%, 7 years times this. This is what we are entitled to. Now, for 1B, the gratuity for 10 years will be 10 years, and what is the final salary then? 12. Therefore, I come here is a product of 10%, 10 years, and the annual salary. Now, what is C? C says 11 years. It's still 10%, but 11 years times the final salary. And that will be 10%, since it has not changed, 11 years. Yes. What is D? D is 12 years. Given that I have spent 12 years, it's still 10%, 12 years, and the 13, because the salary has not changed. Which means it is a product of this 12 years and the 13, and that gives this. Now, these are the basis to which gratuity will be paid. Okay. Now, the second question then is, what is the current service cost? Current service cost is simply the increment in this. What is bringing about this increment over time for the same person is as a result of one, he has spent additional year or years of service. But since we talk about current service costs, we are only talking for a single year in each year, which means it is an increase in the present value of the defined benefit obligation, which in this case is a gratuity, based on the fact that one, he has spent additional year of service. And as a result of that, he might have also gotten increment in salary, which will impact that gratuity. And thirdly, he might have gotten promotion, which would also have impacted the salary, which ultimately would have impacted the gratuity. Therefore, the current service cost at 11 years, that is year 11, and 12 years, that is year 12, is as thus. Year 11, the current service cost will have been the difference in the gratuity amount in year 10 and year 11, which is attributable to the combination of the following. A, additional year of service, and B, salary increments and or promotions. Therefore, in this case, the current service costs in year 11 is the difference between 14.3 and 12 million, which is 2.3. We'll replicate the same thing for year 12. But in this case, it will be different between year 11 and year 12. And the current service for year 12 is the difference between this and this, which is 1.3 million, which is attributable to additional years of service. And that is what we mean by current service what? Does that make sense?
Yes, it does.
Any question?
Please, I have a question, though I need to step out as soon as possible, but I will join again. Okay, this is my question. In a situation whereby an organization have its own retirement benefit plan, like it keeps them for its employee, it's not as if it's registered with.
I can't hear you well. Your voice is not loud enough.
Okay, I'm saying in a situation whereby an employer is not engaging in service of any PFA, any pension fund administrator in Nigeria, but he keeps those retirement benefits by himself on behalf of the employees. Is it allowed under Nigerian law and also under IFRS 19? I mean IAS 19.
That is what we call closed pension. And most closed pension are defined benefits. Unfortunately, you didn't start with us. Probably when you watch the video, you understand more about it.
Okay, sir.
Most closed pensions are defined benefit contribution.
Okay.
Defined benefit plan, sorry. While that of the PFA is mostly defined benefit, defined contribution plan.
Okay.
That is it. We've discussed that extensively.
Okay, it's all right. I'll go back.
Yeah.
I'll go back. Thank you.
Now, that is current service cost for us. Now, let me pick this and let me copy it on our sheet. Okay. That is that. Does that answer our question now?
Yes, sir.
Now let's, for the
Okay,
sake of our
hello,
understanding.
hello, Mr.
Yes.
Mr. Muiwa.
Yes, sir.
Now, to further what question Chego was asking, this the defined what the law stipulates now in Nigeria is that is the defined contribution plan. So what has happened? I think that from my own little experience, my working experience, that most organizations have migrated to defined contribution plan, and they have paused the defined benefit plan. I think the defined benefit plan was what was obtainable before, but currently the defined contribution plan is what is obtainable now. I have not come across an organization that is running both per se.
Okay. Now, let me explain to us, okay? The Pension Act of 2014, primarily for those open-ended plan or fund, which is with the PFAs and defined contribution. But most closed-ended ones are not defined contribution. They are more or less defined benefit plan or a modified savings plan. Do you get what I'm saying now? And the fourth majorly under defined benefit plan. Okay. Secondly, there are up to some period, there are some companies that were still operating both defined benefit and defined contribution plan. Based on Pension Act 2004, they were using defined contribution plan, benefit plan. And when there was migration to defined contribution, they still maintain that other one as gratuity, separate from pension. But upon the adoption of IFRS, many companies saw the exposure for the first time based on actual valuation, and most of them have to disengage or curtail such a plan and make settlement out of it. Okay, but that doesn't stop. I still have one or two companies I know in Nigeria that still maintain both contribution plan, defined contribution plan, and defined benefit plan. The defined contribution was maintained for pension in line with the Pension Act of 2014, and defined benefit plan based on their internal gratuity mechanism, which they still continue to operate. Is that okay?
Okay, secondly, a quick one. Now, based on the organizations I've worked, I realized that those organizations had that defined benefit plan. So, they like where I worked before, there was the defined benefit plan, and after some time, they stopped it for some category of staff, saying that once you're employed at this period, you are not entitled to defined benefit. They didn't use defined benefit. You are not entitled to gratuity again.
That is curtailment. The curtail,
So,
yeah.
So that is what I've come across mostly. And secondly, this way of accounting for it, I've not really seen, even where I work presently, they don't have, they had that defined benefit plan. So there was a policy, I think last 2 years ago, and they said that they are not going to, people are no more entitled to the gratuity if you, just like what I said, that if you are employed this period or this and that. So they started curtailing this defined benefit plan. But I realized that they were not actually applying all this accounting, actual valuation stuff. It's just when they want, someone is leaving, they just calculate it cash, and that year is an expense in the book.
And
So
therefore,
I guess,
in that
hello?
situation, it will be a responsibility of both management and the auditor to have done what is right, which I think they might have failed in that respect.
Okay, maybe it depends on how large or whatever the organization is, because most times, like the two places I've worked, I've come across this, and they had that defined benefit which they actually curtailed, and there was no calculation. It's just that when somebody is going, they just calculate it for the person. This is a gratuity, and his expense that year.
Okay.
Even I just wonder.
The only acceptable means of that is if it is not material to the operation. But I barely disagree if it will not have been material to the operation of the company. Do you get what I'm saying now? I would bet to disagree on that. Do you get what I'm saying now?
Okay.
But even if it's not material to the operation, they're supposed to have accrued for such on a simple basis, similar to the way we have accrued for defined contribution plan, so that they can be able to ensure that at every point in time, they capture the liability as at when due, and the expense has been matched appropriately with the income.
Okay.
Yeah.
Okay. Thank you.
Okay, the next thing we want to discuss is the past service cost. Okay, is the past service cost. Now, what is our past service cost? I'll break it down for you. Now, past service cost is more or less like any modification to a pension plan that will either increase the obligation of the employer to that pension plan, or will decrease the obligation of that employer to that pension plan, which is solely attributable to past years of service with the employee has rendered to the organization. And let me give you a practical example for that. Let's go back to the exercise we did. On the Excel sheets. Now, imagine we are now told that in 2012, that because of the challenges of COVID-19, the company has resolved to the fact that we no longer make use of 10% because the company might not be able to meet up. Therefore, the company management has said going forward is 6%. And the 6% will be applied upon exit of any staff. Upon exit of any staff, as if it's what has been applied from the beginning. What it then means is that rather than make use of 10%, we are now reducing everything to 6% of the 12 years of the final salary. And in that case, instead of growing the plan to 15.6, the plan is reduced to 9.3. Or vice versa. The company might be a fintech where things are booming. And instead of reducing, they even claim that employees that has contributed to this success will have to benefit. And therefore, the plan has been restructured or modified to now pay out 12%. And if it's 12%, what it simply means is that the gratuity will increase to 18.7. Now, what is our past service cost? Our past service cost is a change. The word change means the increase or decrease in our defined benefit obligation that is attributed to the modification in the pension plan that is attributable to past years of service by the employee, which means that would be what we have here. And what would that be? In this case, for this second scenario, there's an increment of 3.12 million. But if conversely, the case is D, okay, let me do D1, D2. This is D2, 2 asterisk. This is D1, 1 asterisk. It is reduced to 6%, or let me say reduced to 8%. And this is increased to 12%, which means plus or minus 2%. Therefore, in this case, what do we have? We have 8% of 12 years times 13. Whereas here we have 12%, which means in this case, the containment is a reduction, sorry, the modification is a reduction. And because it is 2%, you can see that the amount of reduction of 2% is the amount of increase of 2%. And what that means our past service cost in this first case, determining past service cost this is where there's a decrease. And where there's what? An increase. That is it. This is what we mean by past service cost. Past service cost, as we have seen earlier, let me copy it. Past service cost, as you have seen here, is the increase or decrease in the present value of your defined benefit obligation for employee service in the prior period, resulting from plan amendment or curtailment. Okay, whereby there is a significant reduction by the entity in the number of employees covered by the plan, if it's for curtailment, or there's an amendment to the plan in terms of modification. Okay, that is that. Take notes. This year I'm showing here is not year 21. Let me correct that. It is year 12. Year 12. Take note of that. Okay, any question before we move further? Now, let's see what we have done so far. Have we been able to cover all of it? And I'm going to explain it later. Now, we've done interest, contribution, benefit paid settlement, and we have shown remeasurement gain or loss on planned assets. For the liability, we have discussed current service costs, interest costs, past service costs, benefit paid settlement, and we have shown the actual gain or loss or remeasurement loss or gain on defined benefit obligation. Now for current service costs. Current service costs, as you see it here, is predetermined ab initio. And that current service cost that we are predetermined ab initio in the year before where it occurs would have been, let me write it down. Would have been recognized at discounted value. And I'm going to explain that. Now to explain that, I'm going to put up an exercise, which I'll put up on my Excel document here. I switch back to the Excel. Now let me pick my question. Okay, I want somebody to read this before we proceed to answering this question. Who will read?
Okay. Constructive obligation. IAS 19 makes it very clear that it is not only its legal obligation under the former terms of a defined benefit plan that an entity must account for, but also for any constructive obligation that it may have. A constructive obligation which will arise from the entity's informal practice exists when the entity has no realistic alternative but to pay employees benefit. For example, if any change in the informal practice would cause unacceptable damage to employee relationships. The projected unit credit method. With this method, it is assumed that each period of service by an employee gives rise to an additional unit of future benefits. The present value of that unit of future benefits can be calculated and attributed to the period in which the service is given. The units, each measured separately, build up to the overall obligation. The accumulated present value of discounted future benefits will incur interest over time, and interest expense should be recognized. These calculations are complex and would normally be carried out by an actuary. In the exam, you will be given the figure, but the following example from IAS 19 is included to explain the method. Example, define benefits, obligations, and current service costs. A lump sum benefit is payable on termination of service and equal to 1% of final salary for each year of service. The salary in year one is $10,000 and is assumed to increase at 7% compound each year. The discount rate used is 10% per year. The following table shows how the obligation builds up for an employee who is expected to leave at the end of 5 years, assuming that there are no changes in actuarial assumption. For simplicity, this example ignores the additional adjustment needed to reflect the probability that the employee may leave the entity at an earlier or later date.
Thank you very much. Now, let us now switch to our Excel, and we'll demonstrate our understanding and I want us to pay more attention, because this will show you what we mean by the projected unit credit method, how we determine our current service cost and our present value of defined obligation plus the interest cost. Now look up. Can you see the Excel? Okay.
Yes.
Okay, I think you can see clearly. Okay, now let's pick it one by one. What are the variables in the question? First, we're given initial salary. In year one. What is initial salary? $10,000. Currency. Okay. Second information given to us is the pension rates, Abby. And the pension rate is 1%, which is based on projected final salary. What projected means you estimated it. It's until the person retired before you know the actual final salary. And here we are told that increments in salary as projected on an annual basis is 7%. compounded. And the discount rate, which is the government bond, is 10% per annum. And we're expected that the staff will live for 5 years, which means duration for the employee is 5 years. Duration in years is 5 years. Okay, these are all of the information. Now the question you are going to do first is that first, step 1, we estimate the final salary in year 5. And the final salary at year 5 is what? It's for you to compound. Remember the formula for compounding. 1 plus R. What is R now? Is the rate of increment, 7%. For how many years? How many years will you compound? Based on this information, will you compound for 1 year, 2 years, 3, 4, or 5 years?
5 years.
Is that correct?
I think it is, we expect to live at the end of 5 years.
Enaro,
Yes, sir.
you compound for 5 years. Is that correct?
Or year, okay, if year 1 is 0, then
You compound for 4 years.
okay, year 1 will be 0.
Why is 4 years? I will explain. You compound for what? 5 minus 1. I'll do it for you. You compound for 5 years, 4 years. And these 4 years, I can call this 4 years compounding factor. Compounding what? Factor. 4 times. Why is it 4 times? I will explain. But this compounding factor is what you apply and multiply it by your initial salary. And that is when your salary will have been projected to be this in dollars. Now, this is what you have derived. Now, let me break it down for you in a layman's language. Analyze as thus. Your first year 1 salary. This is the salary you earn in your first year. In your second year, year 2, there will have been an increment. Increase in it will have been 7% of 10,000. Can you remember? Which means if you get increase of 10,000, it means 7% of 10,000 this is what you get. And as at end of year 1, what you will have as at end of year 1, no, sorry, end of year 2 as salary will be this. Now, you replicate the same thing for year 3. Remember, the increment is 7% per year. Year 3 will now be 7% of 10,700, which will give you this in end of year 3. Year 4, in year 4, you also get 7%. That's what compounding means. And you are compounding it on 11449, Abby? And that's what you get in year 4. In year 5, which is the final year, which means in 5 years, your salary can only be increased 4 times. It can't be 5 times. Because you have your base salary, which is year 1, while other one can be increased. Did I get it right, Akifolayan?
Yes, that's correct, sir. It's correct, sir. I would just wish that there is a name to call it. Yeah, so that it's terrible. You are correct.
Now I've solved it in a layman's way.
Yeah, yes, sir.
That is that, which is what we are looking for. Year 5. Now we are projected into year 5. I remember, for simplicity's sake, we have assumed that there is no changes in assumption. As if the person will not die, the person will not see better job, or will not be retrenched. He will spend 5 years, and the salary will increase 7%. COVID-19 will not disrupt. Technology will not advance. Everything remains static the way it is. That is our basic assumption for that understanding. Now, if that is the case, you now ask yourself, this is the final salary. Now, step 2 will now be to project the post-employment benefits. After 5 years. After 5 years, what will have been the gratuity or pension, as the case may be? Remember, what is the formula? The formula is 1% of the final salary times number of service years. Which I mean, in this case, what will be our answer? Our answer will be the product of 1%. How many years? 5 years. And what is the final salary? 13 days. All things being equal. This will be our gratuity. That is, this is what the person is entitled to after 5 years that will pay the person off. Now, the next thing we have to do is to go to step 3. Ascertain or determine current service costs. Our current service cost will be the incremental cost, all things being equal, for additional year of service to the present value of the defined benefits obligation. And that is equal to the average of the pension or gratuity over the years of service. And what is that? Let me remove this equal to there, or let me put a mark there. Is equal to this. Now, if that is the case, what is that amount? What is the average? The average is this amount divided by how many years is the year of service? 5. And that's our current service cost, which is the incremental costs. Let me analyze it. Analyzed as thus. This is the beauty of Excel, and which is difficult for you to do in a normal physical class. I'll come here, I'll say year of service. I have year 1, year 2, year 3, year 4, and year 5. Now, pension, stroke gratuity. If he resigned in year 1, he will have been entitled to 1%, which is a constant, for year 1 of his final salary in year 1, which is $10,000. But if it's year 2, in year 2, will have been entitled to the same 1%, but the final salary in year 2 is 10, and for 2 years. Okay, wait. The final salary, which is what I'm changing, is 10.7, which means this is what you will have gotten in year 2. This is what you will have gotten in year 3. What is different is this. This is what you will have gotten in year 4. And this is what you'll have gotten in year 5. Therefore, what is the incremental? What is incremental? The incremental cost is okay. Now we're going to see what we're going to do in this case. Okay, the first thing we are going to do is that this 31, which is step 3, no, step 4, we discount each of the current service costs as projected back to the present. Back to the present, you are going to see what it means. back to the present means in year 0. Okay. Or let me say in year 1 in that case, which is at the end of year 1. Now, what is it? You have this amount. Yeah. 1, 2, 3, 4, 5. Current service cost for each year is as projected. Therefore, for all of the years, when you sum it up, is what account for this. Now, discounting periods. Now, the one in year 5 will be discounted backward 4 years to the end of year 1. The one in year 4 will be discounted backward 3 years. 2, 1, and 0. How do you arrive at that? It means what you are going to do is simply saying whatever you have as this minus constant 1. Constant 1 is your year 1, which is synonymous to us not increasing the salary in year 1, because that's your first year. You have not even fully enjoyed that one. And we'll drag it down. That is how we get it. Now, what that means is that our discounting factor is 1 plus R. What is our R? The discount rate, which is a constant, raised to power minus N. What is our N in this case is its discounting period. This is 1 because when you discount in year 1 to determine year 1 value, you get the same thing. Okay, discounting, the T is missing. And I drag it down and I obtain for each of the years. Therefore, what is my present value? My present value of each one of them is the product of this discounting factor and this, comma, and this gives me all of this value in dollars. Any question at this point before I proceed? Okay, step 5. What is my present value of defined benefits obligation? DBO. The present value is as follows. In each of the years, year 1, 2, 3, 4, and 5. I'll start with my present value of the defined benefit obligation at the beginning of the year. Or let me say balance brought forward. Okay. Added to that is my interest cost. Added to that is my current service cost. And all things being equal, there's no settlement, there's no curtailment, nothing. I have my defined benefits carried forward. My opening balances and my closing balances. Now, what is my opening balance? It's 0 as at the time the employee joined the business. And my interest cost is the discount rate, which is the product of the discount rate, 10%, applied on the opening balance. Since it's 0, this is also going to be 0. Now, every information here is in dollars. Now, my current service cost for the first year was this. And at the end of the year, I closed out with this. And I'm going to explain what I've done here with respect to time value of money. And I'll use timeline. My closing balance in year 1 is my opening balance in year 2. And my year 2, remember, interest cost is a function of the discount rates and my opening balance. Okay, I didn't log the discount rate. Let me log it. The discount rate is B23. If I can drag it. Now, for year 2, it is 98. My current service cost after discounting. Once I do that, I also replicate it for opening. My opening in year 3 is my closing in year 2. And by the time I do it all, what I have at the end of the day, my current service cost in year 3 is this. In year 4 is this. In year 4 is this, sorry. Year 3 is this. and year 5 is this. At the end of the day, you find out that this 65540 is what we have here. Now look at it, the sum of your interest cost. Sum of interest cost over the years is this amount. And the sum of current service cost, considering the time value of money, is this. The sum of the two would give us our entitlement, assuming there's no change in actuarial assumptions and financial variables. Now, what it simply means is that your defined benefit obligation without any amendment or otherwise to the plan is the aggregate of your current service cost and your interest cost at the end of the day. Now, let me show you something from, I'll put the solution on our Word document for flow of knowledge. And I will explain further from our Word document. Now, look at what I was trying to explain to you guys. If this is a timeline, end of year 1, end of year 2, end of year 3, end of year 4, and end of year 5. Now, each end of the year, there's a current service cost that is projected from our analysis here to be this, 131.08. Simply put, 131. It means there's a contribution of 131 based on the employment of that guy for the first year, another addition of 131 for the second year, another addition for 131 for the third year, another one for the fourth year, and another one for the fifth year. Now, the question then is this. In the first year, this 131 was all projected. If I can call, okay, I won't be able to cut them one by one. Let me change the diagram. Okay. Let me put it like this. Now, in year 5, we are paying 6550. Remember, the 6550 is what we have here. And this 6550 is what is payable in year 5 but it's broken down into the portion in year 1, the portion coming from year 2, the portion coming from year 3, the portion coming from year 4, and the portion coming from what? Year 5. What portion is coming from year 1 is what we have averaged at $131.08, $131.08, $131.08, $131.08, and $131.08. Now, we are not saying that in year 1, if we are to recognize that of year 1 coming back from year 4 will come back how many times? We come back first to year 4, which is -1, second to year 3, which is -2, third to year 2, which is -3, and finally fourth to year 4, which is -4, which means you discount it 4 times. That is this. Okay, now the second one, which is year 2. Year 2 value, which you get in year 4, will be discounted first back in year 1 and year 4, from year 5 to year 4, back again from year 4 to year 3, which is the second time, from year 3 to what? Year 2, which is the first time. Now you are at year 2, which is its present what? Value, which is what accounts for this. Therefore, here I would rather say period, no problem. This is PV. Next, year 3, we discount it from year 5 back for the first time in year 5 to 4. From year 4 back to year 3, it will be 2. At that point, you obtain is PV. And that gives us these 2 types. Now for year 4, you discount back from year 4. That is the value of year 4 you get in year 5. You discount it back from year 5 only once to get to year 4. And the one in year 5 is already at its PV. It's already at its PV. And it is a PV for year 1 that we put here. Okay, let me use the color I've used for each of those years. PV for year 1 is the blue. No, is it blue or red? Is it blue? Therefore, I have made a mistake here. Therefore, let me use blue. This is PV for year 1. PV for year 2 is black. PV for year 3 is, I call this purple, mild purple, as the case may be. PV for year 4 is green. PV for year 5 has its fair value, its future value and present value the same, which is, I think, a thick purple, which is this. And that is that. And invariably, that is how we determine our present obligation, which means in summary, the following steps are what you might have followed. If you now get to a practical question where you have changes in assumptions and you have the plan funded. In this scenario, we assume that the plan is not funded. We only accrue for the liability. Okay. Any other question before we forge ahead? Any question? If there's no question, now to advance in our discussion, these are the steps that we follow in accounting for post-employment plan. And we're going to do that with a demonstration of a question. Okay. I want us to look at this once again. And from there, we'll use it to solve this question. Let me find a comprehensive question for us, which will be critical to our discussion and very much interesting. I'll give us 10 minutes for break. I can use it to resonate on this. And immediately after 10 minutes, by 4:50, we'll converge to solving the problem. And that will be leading us to the end of that discussion by looking at one other comprehensive question that is critical, which we use Excel to solve. Can somebody read the question?
Illustrative question. At 1st January 20x2, fair value of the assets of a defined benefit plan were valued at $1.1 million. And the present value of the defined benefit obligation was $1.25 million. On 31st December 20x, the plan received contributions from the employer of $490,000 and paid out benefits of $190,000. The current service cost for the year was $360,000, and a discount rate of 6% is to be applied to the net liability stroke assets. After these transactions, the fair value of the plan assets at 31st December 20x2 was $1.5 million. And the present value of the defined benefit obligation was $1,553,600 required. Calculate the gains or losses on remeasurement through OCI and their return on plan assets, and illustrate how this pension plan will be treated in the statement of profit or loss and other comprehensive income and statement of financial position for the year ended 31st December 20x2.
Thank you very much. Now, I'll put it on our Excel. The first thing is to bring out our actuarial assumptions and financial variables. Now, what are the actuarial assumptions and financial variables? First is that we are given the fair value of the planned assets as at the beginning of the year, January 2012, was $1 million. Okay. And we are given the present value of defined benefit obligation as at same date to be how much? 1,250. Next is that we are told that on 31st, the plan received contribution. Employers' contribution.
Asset is 1.1 million.
Okay, yeah. Made during the year or as at the end of the year, not during the year, as at year end. This was 1.1 million. Thank you. Okay. Okay. What was contributed? 490 was contributed. And benefit paid out was 190. All figures in thousands. Current service cost was determined. Already we know how to determine that. And that was determined to be 360. Discount rate was set to be 6%. And actuarial valuation or the actuary or the portfolio manager also fair value the planned assets independently at the end of the year. And that was put at 1.5 million. And also the actuary conduct actual valuation based on the projected unit credit method as at the end of the year independently and obtain 1.1,553,600. Now, these are the information that were made available. Now, the examiner wants us to calculate the gains or loss on remeasurement through OCI and the return on planned asset and illustrate how this pension will be treated in the statement of profit or loss and other comprehensive income. Now, before we solve this question, will be ascertained as follows. A, in profit or loss. And B, in other comprehensive income, OCI. In profit or loss, the pension expense will be as follows. The current service cost, if you go back to the illustrative stuff I did earlier, the current service cost is 130. The interest cost is 100. And the expected return is also 100. Therefore, what do we mean? Current service cost is 130. Net interest cost is the difference between interest cost, 100, less expected returns on planned asset, which was coincidentally 100. Therefore, this is 0 in this case. Next, past service cost. Do we have past service costs in our analysis here? Yes, we have it to be 40. I will now have gains or loss on curtailment and settlement. In this case, we settled at 35, but the liability was 5. We had 5 as a loss, which is additional expense. If you remember it here, it's 5, which is from what we have here. We curtailed 25 as our liability, and we expended 30 by way of settlement from our assets. All things being equal, this will give us our net pension costs for the year. And how much is that? 130 plus 0 plus 40 plus 5, 175. Now, net interest cost will have been greater than 0 if we have more of interest cost than expected return. And that is given if we have more of present value of obligation at the beginning than the fair value of planned asset at the beginning. Otherwise, we could have net interest income, which is very rare, and that is attributable to overfunded status. Gain or loss. Gain, if it's a gain, that means we are paying less than the amount we curtailed, and that will be a reduction of our expense. But loss is an additional expense from the conceptual framework definition. Now, in other comprehensive income, what we bring here is your net gain or loss from remeasurement, which is otherwise construed as actuarial gain or loss. remeasurement of your planned assets and your defined benefit obligation. And how do you determine that? If you go back to this analysis we did, for the planned assets, we had remeasurement gain of $50. What we had there was a gain of $50, which means this is a gain because we have more of assets as valued compared to what we expected. And here we have a loss because our liability was higher than expected. Therefore, gain of 50, loss of 155. How do you report it in our other comprehensive income? It will be gain on remeasurement of planned assets, which was 50, less loss on remeasurement of defined benefit obligation, that is planned liabilities, 155. What you report as your net actuarial loss on defined benefit plan is 105, which goes to your other comprehensive income. The knowledge you have here is what we are going to use to answer this question. Therefore, I'll put the question after this exercise. Okay, now this is what I just want to refresh our memories with before we solve that other question. Now let's go back to the exam. Now we have drawn out our variables. Therefore, we have to do it one by one. A is to obtain the fair value of the planned assets as at 31 December 2012. And B is to obtain the present value of the defined benefit obligation as at this. Now for the planned assets, all figure in USD. Fair value of planned assets brought what? Forward. What is the fair value? This is it. And this will be increased by expected returns. It's the same thing as interest income. And that is based on the discount rate, 6%, multiplied by the 1.1 million. Which means I'll come here, the product of this times this. Furthermore, there was contribution made by the employer in the year. And what was contributed will increase investment in the fund. Okay, there was benefit paid to retirees. And that benefit will reduce the asset because you have to sell part of your treasury bill and other things to pay. Okay. What next? What we expect is our expected fair value of planned assets as at end of the year. And what is that? Which means all things being equal, this should have been our value. But what is our actual value? Actual fair value. Of planned assets as at end of the year, as independently valued by the portfolio manager or the actuary, was 1.5. It then means there have been fair value gains from the market beyond what we expected as our actual returns, as our expected returns, which means the difference between these two and this is our actuarial gain. I'll put gain in red, in green, sorry. This is our gain on remeasurement of planned assets. Let me put it in brackets. Balancing or the difference or balancing figure as the case may be. That is that. That is how we have fair valued our planned assets. We replicate the same thing for our planned liabilities. We start with the present value of defined benefit obligations as at 1st of January 2012. And what was that? It was our closing balance last year by the actuary, to be increased by current service costs. Current service cost was 360. It will also be increased by interest cost. And interest cost, similar to our expected return, will be the same discount rate. But now it will be multiplied by the opening balance of the present value of the defined benefit obligation, which is 1,250. The product of the discount factor, 6%, and our opening balance. If we have past service costs, but in this case, it is 0. We don't have past service costs. Okay, thereafter, what do we have? We paid benefits to retirees. It's a reduction. All things being equal, and there was no containment that will have resulted in settlements. Therefore, what is our expected present value of defined benefits obligation? At the end of the year? Okay. All things being equal, what would that give us? This is what we expected to be our liability. But based on the actual valuation that was done by the actuary, based on projected unit credit method, as we have demonstrated it earlier, the value obtained by the actuary was this, which means invariably, the difference between these two will provide us gain or loss on the measurement. Now, who can answer this question? Was it a gain or a loss we have in our liability measurement? Who can answer that?
It's a loss.
Why is it a loss?
Because the actuarial valuation is 1.5 million as against the expected value we got during our computation, which is 1.4.
If your liability that actually surfaces is greater than what you envisage, you are not in a good position. That is what it means. Therefore, this difference is a loss. I'll put it in red. Loss of 58. Okay. Now we have this position with us. The question then is, according to the examiner, calculate the gain or loss on remeasurement. A, it is a net loss or remeasurement of the defined benefit plan. For the year, how do you arrive at that? That is the difference between the loss we have here and the gain we have here. What is the loss we have? 58. Offset it with the gain. Net. What do we have? Net, what we have is actuarial loss. We have net actuarial loss on defined benefit plan for the year, which will be reported through other comprehensive what? Income. B says return on planned assets. What is the return on planned assets? Returns on planned assets can be broken down as thus. When I said return now, the actual actual returns of planned assets can be broken down as follows. 1, expected returns. Plus or minus gains or what? Losses on remeasurement of planned assets. It's not allowing me to put this. I'll just put it in brackets. Positive or negative. If it's a gain, you add. If it's a loss, you deduct. What we have here was a gain. And what we have here was 66. Therefore, this is 100. Next one. Pension plan. How will it be treated in profit or loss? That is C. Our pension expense. True profit or loss, or within our income statement for the year, will be as follows. First is our current service cost. Next is our net interest cost. Or income, as the case may be. Now, what's our current service cost? 360. Our net interest cost is further broken down into offsetting our interest cost What's our interest cost? Our interest cost is 75 less our expected returns or interest income. And that is the 66. Net. What do we have? Is 9,000. This 9,000 is equivalent to 6% of the difference between my liability at the beginning and my asset at the beginning. That is it. Which means the 9,000 is synonymous to discount rate of the net defined benefit obligation as at the beginning of the year, assuming there's no intermittent cash flows. Just take note. Okay, next, past service cost. Although in this case, there's no past service cost, what we have was 0. Benefit paid has no effect because it cancels out. It extinguishes your liability. Finally, we have no gain or loss on curtailment since there is none. What then is our pension cost? All things being equal, it is 369. Finally, what do we report in our balance sheet? In my balance sheet, I'm to report my net retirement benefits assets or obligation first or assets, as the case may be. And I will explain. What you will compare is that at the end of the day, you compare your actual present value, which is this actual amount, and you deduct or net it off with your actual fair value, given that the fund is funded. By actuarial valuation, the actual is 1.553,600. And by portfolio valuation, the fair value of the plan asset is valued at 1.5 million. Net, you have net of pension liability of 53,600 to be reported in your balance sheet as a liability. Whereas if your fair value of plan asset is higher than your liability, in that situation, what you have is much more of a net retirement benefit asset or net plan assets. And that situation is subject to a test. Whenever you have net of an asset for a pension plan, is subject to a test. And that test is what we call the asset ceiling test, which we are going to conduct today. Therefore, I will recognize this as net defined benefit obligation. But if you have more of assets than obligation, it will be of assets. And if it's assets, similar to the one we have done before, we subject it to asset test. And like this one we have done before. Okay, which one have we done before that we did asset and like, okay, we have not done this? Okay, that's that. Any question on this before we move further? Which means what I'll do is this. I'll copy this. Bring it to our notes. Okay. This represents our honest solution to the question.
Sorry. Mr. Moyo, what will be the accounting treatment for actual return on plant assets?
Okay, I'm coming to that. Hold on 1 minute. I want to recopy this so that I can see the negative sign appropriately. Now, your question is this: what is the accounting treatment? Now, you are not treating actual return expressly. You are treating them separately. Expected return, which is a component of the actual return, is treated within profit or loss. That's why it is here, to reduce our pension cost. Why the one attributable to remeasurement of the planned assets, I'll change this not pound, is planned assets, is reported within other comprehensive income, which is what you have here. Do you get what I'm saying now? And you don't treat it as one item. Actual return comprises the expected return and the variability in that return, which is reported through other comprehensive income. Does that answer your question?
Yes.
Thank you. Any other question?
No question, sir.
Okay. Now, I'm coming to give you a more practical question, as we need to maximize our time today. I think this is one of the longest time, and I want to complete it today because it's just one aspect of the employee benefits. The other aspect is the share-based payments. I've also provided you with the materials, and we're going to discuss that probably in the next class on Saturday. Okay. Now, before I go to the next one, I'll more or less reemphasize the following, if I've not done that before. Can you check? Okay, let me give you the following summaries once again. Can somebody read this as one of the summaries I'm providing?
Okay. Can I go ahead now?
Yes.
Okay, past service cost. Past service cost is the change in the present value of the defined benefit obligation resulting from a plan amendment or curtailment. A plan amendment arises when an entity either introduces a defined benefit plan or changes the defined changes the benefits payable under an existing plan. As a result, the entity has taken an additional obligation that it has not hitherto provided for. For example, an employer might decide to introduce a, introduce a medical benefits plan for former employees. This will create a new defined benefit obligation that has not yet been provided for. Service costs. This comprise IAS 19 paragraph 8. This comprise A, current service cost, the increase in the present value of the defined benefit obligation resulting from employee services during the period. The measurement and recognition of this cost was introduced in section 5.1. B, past service cost. The increase or decrease in the present value of the defined benefit obligation for employee service in prior periods resulting from plan amendments or curtailments, whereby there is a significant reduction by the entity in the number of employees covered by a plan. C, any gain or loss on settlement. The detail relating to points B and C above will be covered in later section. First, we will continue with the basic elements of accounting for defined benefit.
We've done that, we've passed that level. Continue.
Okay. Discount rates. The discount rate adopted should be determined by reference to market yields on high quality fixed rate corporate bonds. The bonds should be denominated in the same currency as the benefits to be paid. In the absence of a deep market in such bonds, the yield on comparable government bonds should be used as reference instead. The maturity of the corporate bonds that are used to determine a discount rate should have a term to maturity that is consistent with the expected maturity of the post-employment benefit obligations, although a single weighted average discount rate is sufficient. Okay. The guidelines comments that there may be some difficulty in obtaining a reliable yield for long-term maturities, say 30 or 40 years from now. This should not, however, be a significant problem. The present value of obligations payable in many years' time will be relatively small and unlikely to be a significant proportion of the total defined benefit obligation. The total obligation is therefore unlikely to be sensitive to errors in the assumption about the discount rate for long-term maturities beyond the maturities of long-term corporate or government bonds. Net interest on the defined benefit liability or assets. In section 5.1, we looked at the recognition and measurement of the defined benefit obligation. This figure is the discounted present value of the future benefits payable. Every year, the discounts must be unwound, increasing the present value of the obligation as time passes through an interest charge. Okay. Net interest on defined, okay, I've read that one. Interest calculation. IAS 19 requires that the interest should be calculated on the net defined benefit liability or asset. This means that the amount recognized in profit or loss is the net of the interest charge on the obligation and the interest income recognized on the assets. The calculation is as follows: net defined benefit liability or assets multiplied by discount rates. The net defined benefit liability or assets should be measured as at the start of the accounting period, taking account of changes during the period as a result of contributions paid into the plan and benefits paid out. Many exam questions include the assumption that all payments into and out of the plan take place at the end of the year, so that the interest calculation can be based on the opening balances.
I think that's an expansion of what I've said earlier.
Okay, sir. Remeasurement of the net defined benefit liability. Remeasurement of the net defined benefit liability or assets. Sorry, someone called me. Okay. Remeasurement of the net defined benefit liability or asset comprise IAS 19 paragraph comprise of A, actuarial gain and losses, B, the return on planned assets, and C, any change in the effect of the asset ceiling. The gain and losses relating to points A and B above will arise in every defined benefit plan. So we will look at these in section C. The asset ceiling is a complication, is a complication that is not relevant in every case. So it is dealt with separately later in the chapter. Actuarial gains and losses. Actuarial gains and losses arise for several reasons, and IAS 19 requires this to be recognized in full in other comprehensive income. At the end of each accounting period, a new valuation using updated assumptions should be carried out on the obligation. Actuarial gains or losses arise because of the following. First, actual events, e.g., employee turnover, salary increases, differ from the actuarial assumptions that were made to estimate the defined benefit obligations. The effect of changes in assumptions concerning benefit payment options. Estimates are revised, e.g., different assumptions are made about future employee turnover, salary rises, mortality rates, and so on. The effect of changes in the discount rates. Actuarial gains and losses are recognized in other comprehensive income. They are not reclassified to profit or loss. Return on planned assets. The return on planned assets must be calculated. A new valuation of the planned asset is carried out at each period end using current fair values. Any difference between the new value and what has been recognized up to date, normally the opening balance, normally the opening balance, interest, and any cash payment into or out of the plan is treated as a remeasurement and recognized in other comprehensive income. Asset ceiling test. When we looked at the recognition of the net defined benefit liability or asset in the statement of financial position at the beginning of the section 5, the term asset ceiling was mentioned. This term relates to a threshold established by IAS 19 to ensure that any defined benefit asset, that is pension surplus, is carried at no more than its recoverable amount. In simple terms, this means that any net asset is restricted to the amount of cash savings that will be available to the entity in future. Net defined benefit assets. A net defined benefit asset may arise if the plan has been overfunded or if actuarial gains have arisen. This meets the definition of an asset as stated in the conceptual framework because all of the following apply. The entity controls the resource, the ability to use surplus to generate future benefits. The control is the result of past events, contributions paid by the entity, and service rendered by the employee. Future benefits are available to the entity in the form of a reduction in future contributions or cash refund, either directly or indirectly to another plan in deficit. The asset ceiling, my phone is turning off, I'm sorry.
Okay, can we continue from there?
Okay. The asset ceiling is the present value of those future benefits. The discount rate used is the same as that used to calculate the net interest on the net defined benefits liability or assets. The net defined benefit assets will be reduced to the asset ceiling threshold Any related written down will be treated as a remeasurement and recognized in other comprehensive income. And the asset ceiling adjustment was, if the asset ceiling adjustment was needed in a subsequent year, the changes in its value would be treated as follows. A, interest, as it is a discounted amount, recognized in profit or loss as part of the net interest amount. B, other changes, recognized in profit or loss.
Okay, I'm coming. I wanted to share this summary stuff with you guys. Okay. Now, later on, you can make use of this diagram or this schedule to have better or summary understanding of what we have discussed so far. Everything on this diagram is what we have done, and we are going to replicate it with this comprehensive question. Okay, and let me try and pull out the question. I'll give us this question. I will take about 5 minutes to peruse the question. And I want you to interpret it in your language. This question will have wrapped up all of our discussion today with respect to employee benefit, post-employment benefits. And now, are you there?
I'm here.
Okay, I want you to read this question and you take 5 minutes. Okay, I think there's a noise in your background. Nuruddin, can you read the question? And
Okay.
you guys can take 5 minutes break to deliberate on it. Over to you.
For the sake of simplicity and clarity, all transactions are assumed to occur at the year end. The following data applies to the post-employment defined benefits compensation plan of BCD code. Discount rate 10% each year. Present value of obligation at start of 20x2, $1 million. Market value of plan asset at start of 20x2, $1 million. The following figures are relevant. 20x2, 20x3, 20x4. All figures in $1,000. Current service costs 140, 150, 150. Benefits paid out 120, 140, 150. Contribution paid by entity 110, 120, 120. Present value of obligation at year end 1.2, 1,650, 1,700. Fair value of plan assets at year end 1,250, 1,450, and 1,000.